Welcome. Today we're diving into the world of value management in business. We'll explore how companies measure and manage their performance, why value creation is at the heart of every successful enterprise, and how different stakeholders view value. By the end of this video, you'll understand the key concepts that drive modern business management, from financial indicators to advanced performance metrics. Let's start by setting the stage. What does it really mean to manage for value, and why is it so important in today's competitive environment? At its core, the fundamental goal of any business is to increase its value. This means not just making profits in the short term, but maximizing the long-term market value of the company. For leaders, this translates into making decisions that bring the greatest benefit to owners, while also considering the interests of other stakeholders. Achieving this balance is a continuous process, requiring careful planning, investment, and performance measurement. Let's look at how these goals break down into specific financial and operational targets. One of the most debated topics in business management is the difference between shareholder value and stakeholder value. Shareholders are the owners who provide capital and expect a return on their investment. Stakeholders, on the other hand, include everyone involved with the company: employees, managers, suppliers, customers, and even the government. While shareholders seek the highest possible returns, stakeholders are interested in the company's long-term health and stability. Successful companies find ways to create value for both groups, ensuring sustainable growth. Performance measurement in business has evolved over time. Early approaches focused on simple profit margins and revenue growth. As businesses became more complex, new metrics emerged, such as return on assets (ROA), return on equity (ROE), and return on investment (ROI). Today, advanced indicators like economic value added (EVA) and cash flow return on investment (CFROI) are used to capture a more complete picture of value creation. Each generation of metrics brings new insights, helping managers make better decisions. Let's break down the evolution of financial performance indicators. The first generation focused on profit margins, while the second emphasized profit growth. The third generation introduced capital efficiency metrics like ROA, ROE, and ROI, measuring how effectively a company uses its resources. The fourth generation shifted towards value creation for owners, using tools like EVA and CFRO. This progression reflects a growing understanding that true business success is about more than just profits, it's about creating lasting value. Every business sets both primary and secondary financial goals. The main objective is long-term maximization of market value, ensuring the company remains attractive to investors. Secondary goals might include specific investment projects, operational improvements, or efficiency targets. These sub-goals help guide daily decision-making and keep the company on track toward its overarching mission. By aligning all activities with value creation, businesses can achieve sustainable success. Value management relies heavily on the concept of net present value (NPV). This principle states that the value of an investment is determined by the present value of its future benefits, minus the initial investment. By consistently applying NPV criteria to all decisions, companies ensure that every action contributes to value creation. This disciplined approach helps avoid short-term thinking and keeps the focus on long-term growth. Stakeholders evaluate a company's performance by comparing it to alternatives. Owners, for example, expect returns at least equal to what they could earn elsewhere. If a company fails to deliver, capital will flow to more attractive opportunities. Employees, suppliers, and other stakeholders also weigh their options, seeking the best possible outcomes for themselves. This dynamic keeps companies striving for excellence and ensures that value creation remains a top priority. Maximizing value for shareholders is often seen as the foundation for increasing value for all stakeholders. When a company consistently delivers strong returns to its owners, it attracts investment, supports growth, and creates opportunities for employees and partners. This virtuous cycle benefits everyone involved, reinforcing the importance of focusing on shareholder value as a core management principle. Can't manage what you can't measure. This simple truth underpins the entire field of performance management. Without clear metrics, it's impossible to evaluate progress or make informed decisions. That's why companies rely on a variety of indicators to track their financial health, operational efficiency, and overall success. Let's explore the most important performance metrics used in business today. Traditional performance indicators include metrics like return on investment (ROI), return on equity (ROE), return on assets (ROA), earnings per share (EPS), and various cash flow measures. These classic tools have been used for decades to assess profitability, efficiency, and financial stability. While they provide valuable insights, they also have limitations, especially in today's fast-changing business environment. Modern performance indicators go beyond traditional metrics. Tools like economic value added (EVA), market value added (MVA), cash flow return on investment (CFROI), and shareholder value analysis (SVA) provide a more comprehensive view of value creation. These measures account for the cost of capital, risk, and long-term sustainability, helping managers make smarter, more strategic decisions. While classic indicators like profit and cash flow are useful, they have notable weaknesses. Many are based on accounting figures that can be influenced by policy choices, don't account for inflation or risk, and may include non-operational items. This can make it difficult to get a true picture of a company's performance. As a result, managers and analysts increasingly turn to modern metrics that address these shortcomings. Profit indicators can be affected by a company's accounting policies and may include revenues or costs unrelated to core operations. For example, non-operational gains or losses or extraordinary events can distort the true picture. This is why relying solely on profit metrics can be misleading, especially when making strategic decisions. Another challenge with traditional metrics is how they treat assets and capital. Not all assets are owned by the company, some may be leased or not fully reflected on the balance sheet. Intangible assets like strong supplier relationships or skilled employees are often excluded because they're hard to quantify. This can lead to an incomplete assessment of a company's true value. Profitability indicators like return on equity are not always reliable measures of performance. They need to be compared with the opportunity cost of capital to be meaningful. Moreover, these indicators don't reflect business risk or the risks associated with using borrowed capital. This is why modern approaches incorporate risk and capital costs into performance measurement. Financial analysis is one of the most important tools for business management. It evaluates past and current performance from various perspectives and provides the foundation for future decisions. By analyzing key indicators, managers can identify strengths, weaknesses, and opportunities for improvement, ensuring the company stays on the path to value creation. Some of the most widely used profit indicators include EAT earnings after tax, EBT earnings before tax, EBIT earnings before interest and tax, and EBITDA earnings before interest, tax, depreciation, and amortization. Each provides a different perspective on profitability, helping managers understand both operational and overall financial performance. Cash flow indicators document the movement of money within a company. Monitoring cash flow is essential for understanding liquidity and financial health. Companies can measure cash flow directly or indirectly, and key metrics include free cash flow (FCF) and operational cash flow. These indicators help ensure the company can meet its obligations and invest in future growth. Profitability ratios measure how effectively a company generates profit from its resources. Common ratios include total debt to assets, debt to equity, and interest coverage. These ratios provide insights into the company's financial structure and its ability to manage debt and generate returns for investors. Liquidity ratios assess a company's ability to meet its short-term obligations. Key metrics include current ratio, quick ratio, and cash ratio. These indicators help managers ensure the company has enough resources to cover its debts and maintain financial stability, especially in times of uncertainty. Activity ratios measure how efficiently a company uses its assets. These include asset turnover, inventory turnover, and receivables turnover. By tracking these ratios, managers can identify areas where resources are being used effectively and where improvements are needed to boost efficiency and profitability. Comprehensive indicators like Altman's Z-score and the IN index provide an overall assessment of a company's financial health. These models combine multiple metrics to predict bankruptcy risk or evaluate financial stability. By using comprehensive indicators, managers gain a deeper understanding of the company's strengths and vulnerabilities. Pyramid systems of indicators break down complex financial performance into simpler components. For example, return on equity ROE can be decomposed into several ratios, each highlighting a different aspect of performance. This approach helps managers pinpoint the drivers of success and identify areas for improvement. Financial analysis has its limitations. It often relies on historical data which may not reflect current realities. Differences in accounting practices, seasonal factors, and the impact of inflation can all distort results. Managers must be aware of these weaknesses and use financial analysis as just one tool among many for decision-making. Market-based ratios such as the price-earnings (PE) ratio and price-book value (PBV) compare a company's market value to its earnings or book value. These ratios are widely used by investors to assess whether a stock is undervalued or overvalued, providing important insights for investment decisions. Modern performance measurement approaches such as discounted cash flow (DCF), market value added (MVA), economic value added (EVA), and cash flow return on investment (CFROI) address the shortcomings of traditional metrics. They incorporate risk, the cost of capital, and future expectations, providing a more accurate picture of value creation. Modern performance metrics must use as much relevant accounting data as possible, include risk calculations, and reflect the cost of capital. By doing so, they provide a more realistic assessment of a company's ability to create value over time. This shift has transformed how managers evaluate investments and performance. Discounted cash flow (DCF) method evaluates investments by calculating the present value of expected future cash flows. The goal is to maximize market value added (MVA), which represents the difference between the market value and the invested capital. DCF helps managers decide whether an investment will create value, considering both returns and the cost of capital. Excess return measures the actual wealth created by a company compared to what was expected. It's calculated as the difference between the actual value generated, like dividends and share price increases, and the expected value. This metric helps investors and managers assess whether the company is truly outperforming expectations. Economic value added (EVA) is a modern metric that measures how much value a company creates beyond the required return on its capital. EVA is calculated by subtracting the cost of capital from the company's net operating profit after taxes. If EVA is positive, the company is generating value. If negative, it's destroying value. EVA is widely used for performance measurement, investment evaluation, and incentive systems. There are several ways to calculate EVA, but the core idea remains the same: measure the company's true economic profit. The most common formula is EVA equals NOPAT WACC times capital, where NOPAT is net operating profit after taxes, WACC is the weighted average cost of capital, and capital is the invested capital. This approach ensures that all costs, including the cost of equity, are considered. EVA is a powerful tool for measuring company performance. It connects strategic and operational management by focusing on value creation. Companies use EVA to evaluate all activities and decisions based on their contribution to value. This helps align the entire organization around a common goal and drives long-term success. EVA is also used to evaluate investment projects. By applying the EVA model to investment calculations, companies can standardize their approach and ensure that every project is assessed based on its contribution to value creation. This leads to better investment decisions and more consistent performance across the organization. EVA plays a key role in company valuation and acquisitions. The market value of a company can be seen as the sum of its invested capital and the present value of future EVA. This approach captures the main drivers of value and provides a clear link between operational performance and market expectations. EVA is often used as the basis for incentive systems. Employees and managers can receive bonuses tied to increases in EVA, aligning their interests with those of the company's owners. This approach encourages long-term thinking and rewards actions that genuinely create value, rather than just short-term gains. In the Czech Republic, EVA is mainly used as part of financial analysis and reporting, rather than as a full-fledged value management concept. However, its adoption is growing as companies recognize the benefits of focusing on value creation and aligning management practices with international standards. There are two main models for calculating EVA, the accounting model and the economic model. The economic model adjusts the accounting figures to better reflect the true value created by the company. This involves removing non-operational assets and liabilities and making other adjustments to ensure that only core business activities are measured. To calculate economic EVA, it's important to exclude non-operational assets, such as financial investments or unfinished projects and non-interest-bearing liabilities. This ensures that EVA reflects only the value generated by the company's main business activities, providing a more accurate measure of performance. Net operating profit after taxes (NOPAT) must also be adjusted to align with the economic model. This means excluding interest expenses, extraordinary items, and non-operational income or costs. The goal is to measure the true profit generated by the company's core operations after accounting for all relevant taxes. EVA offers several advantages as a performance metric. It provides a clear measure of value creation, supports value-based management, and serves as a motivational tool for managers. EVA separates the impact of core business activities from extraordinary events, making it easier to evaluate true performance and make informed decisions. Despite its strengths, EVA has some drawbacks. Calculating EVA requires complex adjustments, especially for NOPAT and invested capital. It can be difficult to estimate the true cost of equity, and EVA does not account for inflation or future benefits. Managers must be aware of these limitations when using EVA for decision-making. EVA bridges the gap between strategic and operational management. By focusing on value creation, it helps companies align their long-term strategies with day-to-day operations. This integration ensures that every decision from investment to resource allocation supports the company's overarching goal of maximizing value. Practice, EVA is used to evaluate company performance, guide investment decisions, and design incentive systems. Companies that adopt EVA often see improved alignment between management and shareholder interests, better resource allocation, and a stronger focus on long-term value creation. As more businesses embrace value-based management, EVA is becoming an essential tool for success. Let's start by setting the stage. Value growth isn't just about profits, it's about sustainable strategies that enhance a company's long-term potential. Throughout this video, we'll guide you through the key principles and tools used by top-performing organizations to achieve and measure value growth. The heart of value growth are people, especially top management. Senior leaders are primarily responsible for setting the direction and making decisions that impact the company's value. However, managers at all levels play a role. While executives focus on big-picture strategies, lower-level managers influence factors within their control, such as operational efficiency or customer satisfaction. By aligning everyone's efforts, organizations can ensure that value creation is a shared goal. This collaborative approach helps identify which factors truly drive value and how each team member can contribute to the company's success. Grow value, companies must identify the key factors, known as value drivers, that influence their worth. These can include revenue growth, profit margins, operational efficiency, and effective use of capital. By focusing on these drivers, businesses can make informed decisions that lead to sustainable growth. Tools like value-based management help organizations pinpoint which elements have the greatest impact and how to measure their effects. This process is essential for setting priorities and allocating resources where they'll make the most difference. There are several approaches to value management, each with its own set of value drivers. While the details may differ, most frameworks share common themes, such as maximizing cash flow, improving profitability, and managing risk. For example, the CFROI cash flow return on investment method measures how well a company uses its investment base to generate cash flow. Other approaches like economic value added (EVA) focus on creating returns above the cost of capital. Understanding these concepts helps managers choose the right tools for their organization's needs. The FROI, or cash flow return on investment, is a key metric for evaluating a company's performance at the enterprise level. It measures the return generated from the company's gross investment base through achieved cash flows. For lower management levels, the total business return (TBR) is often used in connection with CFROI. By comparing CFROI to the company's cost of capital (WACC), managers can determine whether investments are truly adding value. This approach ensures that capital is allocated efficiently and only projects that exceed the cost of capital are pursued. Shareholder value is a central concept in value management. It's measured by factors like achieved revenues, revenue growth rate, operating profit margin, and tax rate. The value of a business is closely tied to the cash flow generated from its operating assets, especially after competitive advantages are exhausted. Using external capital can also be a value driver, as it may increase returns on equity. By tracking these metrics, companies can ensure they're on the right path to maximizing shareholder value. Economic value added, or EVA, is a popular value management tool that can be applied at all management levels. EVA measures the value created above the required return of the company's shareholders. While its calculation can be complex, especially at lower management levels, it's a powerful motivator when linked to performance incentives. By identifying EVA generators, specific metrics or activities that drive future EVA, companies can align employee goals with value creation. There are four main ways to increase EVA. Boost revenues by growing the business, but only invest when new projects earn more than their capital cost. Reduce capital by selling off unnecessary assets. Manage risk and capital costs and improve operational efficiency. Each of these strategies requires careful analysis and disciplined execution. By focusing on these levers, companies can systematically enhance their economic value added and ultimately their market value. Growing revenue is a classic way to increase value, but it's important to invest only in opportunities that generate returns above the cost of capital. This means evaluating new projects carefully and ensuring they contribute positively to the company's financial health. Sustainable revenue growth comes from understanding market needs, innovating products or services, and maintaining strong customer relationships. By balancing growth with prudent investment, companies can avoid overextending themselves and ensure long-term success. Another way to boost value is by reducing the capital tied up in unproductive assets. This might involve selling off non-core business units or streamlining operations to free up cash. By focusing resources on the most effective areas, companies can improve their return on capital and enhance overall efficiency. This approach not only strengthens the balance sheet, but also provides funds for future growth opportunities. Operational profit is determined by both revenue and operating costs. Increasing sales volume and optimizing pricing can boost revenues, while controlling production costs and improving process efficiency can reduce expenses. The ability to manage these factors effectively is a key driver of business value. Companies that excel in operational management are better positioned to generate higher profits and sustain competitive advantage. Efficient use of capital is crucial for value creation. The ratio of sales to assets indicates how well a company utilizes its resources. High asset turnover suggests effective use of capital, while low turnover may signal inefficiencies. Regular analysis of asset utilization helps identify areas for improvement and ensures that capital is allocated to its most productive uses. Level of taxation on operating profit directly affects a company's net earnings. Effective tax planning and management can enhance profitability and free up resources for reinvestment. Companies should regularly review their tax strategies to ensure compliance while minimizing unnecessary costs. This proactive approach supports sustainable value growth and strengthens the company's financial position. Balanced Scorecard (BSC) is a strategic management tool that integrates financial and non-financial performance measures. Developed by Kaplan and Norton, BSC expands traditional financial metrics by adding new indicators that drive future performance. It evaluates a company from four perspectives: financial, customer, internal processes, and learning and growth. This holistic approach ensures that organizations balance short-term results with long-term capability. Financial perspective of the Balanced Scorecard focuses on satisfying shareholders by increasing the value of their investment. Key metrics include profitability, revenue growth, and return on investment. By tracking these indicators, companies can ensure they're meeting the expectations of owners and investors. Financial goals are often linked to broader strategic objectives, providing a clear link between daily operations and long-term value creation. Customer perspective emphasizes the importance of customer satisfaction, loyalty, and profitability. Metrics may include market share, customer retention, and acquisition rates. By understanding and meeting customer needs, companies can build strong relationships and secure long-term revenue streams. This perspective encourages organizations to prioritize quality, service, and innovation in their offering. Internal process perspective focuses on the efficiency and effectiveness of business operations. Key metrics might include process cycle times, quality rates, and innovation measures. By optimizing internal processes, companies can reduce costs, improve quality, and respond more quickly to market changes. This perspective drives continuous improvement and supports the achievement of strategic goals. Learning and growth perspective highlights the importance of employee skills, information systems, and organizational culture. Metrics may include employee training, knowledge sharing, and engagement levels. By investing in people and technology, companies can build the capabilities needed for long-term success. This perspective ensures that organizations remain adaptable and ready to seize new opportunities. Strategic Map is a visual tool that links objectives, measures, and value drivers across all four balanced scorecard perspectives. It clarifies what needs to be done and who is responsible for achieving each goal. By mapping out cause and effect relationships, organizations can ensure that every action supports the overall strategy. This clarity helps align teams and resources toward common objectives. Successfully implement strategic performance management, companies must connect the balanced scorecard to their reward systems. This means linking employee incentives to the achievement of strategic goals. When rewards are tied to performance metrics, employees are more motivated to contribute to value creation. This alignment ensures that everyone is working toward the same objectives and that success is recognized and rewarded. The balanced scorecard to be effective, it must be integrated throughout the entire organization. This requires breaking down strategic objectives into actionable targets for each department and team. Coordination and communication are key to ensuring everyone understands their role in achieving the company's goals. By embedding BSC into daily operations, companies can drive consistent performance and continuous improvement. Strategic investment decisions are among the most important activities in any business. These decisions have long-term impacts on the company's prosperity and can either enhance or threaten future performance. Factors influencing investment decisions include the time horizon, associated risks, the need for coordination, and the size of the financial commitment. Careful evaluation and planning are essential to ensure investments contribute positively to value growth. There are several methods for evaluating investment projects, including net present value, NPV, internal rate of return IRR, payback period, and discounted cost methods. NPV is considered the most reliable as it accounts for the time value of money and includes all cash flows over the project's life. IRR expresses the project's return as a percentage, making it useful for comparing different opportunities. Each method has its strengths and limitations, so it's important to choose the right one for your situation. Present value, or NPV, is a key metric for assessing whether an investment will add value to the business. A project should only be pursued if its NPV is positive, meaning the present value of future cash flows exceeds the initial investment. NPV takes into account all cash inflows and outflows, including profits, depreciation, and changes in working capital. This comprehensive approach ensures that investment decisions are based on a complete financial picture. The internal rate of return, or IRR, is another important investment evaluation tool. IRR is the discount rate at which the present value of future cash flows equals the initial investment, resulting in an NPV of 0. It represents the expected annual return of a project. While IRR is useful for comparing projects, it can be misleading in cases with non-standard cash flows or mutually exclusive investment. Always use IRR alongside other metrics for a balanced assessment. Analyzing how assets are used is essential for improving efficiency and value creation. Key indicators include asset turnover ratios and the age of assets. High turnover suggests effective use, while low turnover may indicate excess or underutilized resources. Regularly reviewing asset utilization helps companies identify opportunities to optimize their asset base and improve overall performance. Effective inventory management ensures that capital isn't tied up unnecessarily, while also preventing production delays or customer dissatisfaction. Techniques like just-in-time delivery and consignment warehouses can help optimize inventory levels. The goal is to balance the need for sufficient stock with the desire to minimize holding costs. Good inventory management supports smooth operations and contributes to value growth. Managing receivables is critical for maintaining healthy cash flow. This involves setting clear payment terms, offering discounts for early payment, and using legal tools like liens or guarantees to secure debts. Companies may also use factoring or forfeiting to convert receivables into immediate cash. By actively managing receivables, businesses can reduce financial risk and improve liquidity. Cash management is about ensuring the company has enough funds to meet its obligations while maximizing the use of available resources. Motivations for holding cash include transaction needs, risk management, and speculative opportunities. Companies use models to forecast cash flows and maintain optimal balances. Effective cash management reduces the risk of shortages and supports strategic investment. Working capital management has a direct impact on a company's need for financing and its profitability. Efficient management involves converting inventory and receivables into cash quickly, while delaying payments to suppliers when possible. This results in higher liquidity and greater flexibility. By optimizing working capital, companies can reduce financing costs and improve overall performance. Factoring and forfeiting are financial tools used to manage receivables and improve cash flow. Factoring involves selling receivables to a third party at a discount, while forfeiting is the sale of longer-term receivables, often for export transactions. Both methods provide immediate cash and reduce the risk of non-payment. These tools can be especially valuable for companies with significant sales on credit. Understanding the cost of capital is essential for making sound investment and financing decisions. The cost of capital represents the price a company pays to obtain funds, whether through debt or equity. It's also the minimum return investors expect for providing capital. By calculating the weighted average cost of capital, WACC, companies can evaluate whether projects are likely to create value. Cost of capital plays a central role in investment decisions. It's used as the discount rate for evaluating future cash flows and as a benchmark for project approval. Only investments with expected returns above the cost of capital should be pursued. This ensures that resources are allocated to projects that truly add value and support the company's long-term goals. Optimal capital structure balances debt and equity to minimize the company's overall cost of capital. While debt can offer tax advantages, too much leverage increases financial risk. The ideal mix varies by industry and company, but the goal is always to achieve the lowest possible cost while maintaining financial stability. Regular reviews help ensure the capital structure remains aligned with business needs. Cost of capital significantly affects business performance. Higher capital costs reduce profitability and increase risk, while lower costs improve margins and financial flexibility. Factors influencing capital costs include company size, risk profile, liquidity, and market conditions. By managing these factors, companies can enhance their competitiveness and create more value for stakeholders. Cost of debt is calculated as the weighted average of effective interest rates on all forms of borrowed capital. It's important to include all interest-bearing liabilities such as loans and bonds, while excluding non-interest-bearing items like trade payables. Accurate calculation helps companies assess the true cost of financing and make informed decisions about capital structure. Cost of equity reflects the return investors expect for holding a company's shares. It typically estimated using models like the Capital Asset Pricing Model, CAPM, which considers the risk-free rate, the company's beta risk relative to the market, and the market risk premium. By understanding the cost of equity, companies can evaluate whether they're delivering sufficient returns to shareholders. Capital Asset Pricing Model, CAPM, is widely used to estimate the cost of equity. It breaks down risk into systematic market and unsystematic company-specific components. The model calculates expected return as the sum of the risk-free rate and a risk premium, which is the product of the company's beta and the market risk premium. CAPM helps companies and investors assess whether an investment offers adequate compensation for its risk. Arbitrage Pricing Theory (APT) is another model for estimating the cost of equity. Unlike CAPM, which relies on a single risk factor beta, APT considers multiple macroeconomic factors that can affect returns. While more complex, APT provides a broader view of risk and can be useful for companies operating in volatile or diverse markets. Both models help inform investment and financing decisions. Price-earnings ratio, or PE, is a common metric for evaluating a company's valuation. It's calculated by dividing the market price per share by earnings per share. A high PE may indicate growth expectations, while a low PE could signal undervaluation or risk. PE is often used alongside other metrics to assess investment attractiveness and compare companies within the same industry. Financial risk management is about balancing the benefits of debt with the need for stability. While using external capital can enhance returns, excessive leverage increases the risk of financial distress. Companies must monitor their risk profile, maintain adequate liquidity, and ensure they can meet obligations even in challenging times. Prudent risk management supports sustainable value growth and protects stakeholders. Sum up, growing business value requires a strategic approach that integrates financial management, operational efficiency, and risk control. By focusing on key value drivers, using robust evaluation methods, and aligning incentives with strategic goals, companies can achieve sustainable growth. Regular review and adaptation ensure that strategies remain effective in a changing business environment. Applying these concepts in practice involves setting clear objectives, measuring performance, and continuously seeking improvement. Use tools like the Balanced Scorecard to track progress across multiple dimensions and ensure that all employees understand how their work contributes to value creation. Stay informed about market trends and be ready to adjust strategies as needed to stay competitive. Building a culture of continuous improvement is essential for long-term value growth. Encourage innovation, invest in employee development, and foster open communication. By empowering teams to identify and solve problems, companies can adapt quickly and maintain a competitive edge. Remember, value growth is an ongoing journey, not a one-time achievement. Thank you for joining us on this deep dive into business value growth. We've covered the main drivers, strategic frameworks, and practical tools for enhancing company value. Remember, success comes from integrating financial discipline, strategic planning, and a commitment to continuous improvement. Apply these principles in your organization to unlock new levels of performance and long-term value. Welcome to our comprehensive guide on business valuation, financial planning, and controlling. In today's fast-paced business world, understanding how to assess a company's value and manage its finances is crucial for long-term success. Whether you're an entrepreneur, investor, or manager, mastering these concepts can help you make informed decisions and drive sustainable growth. Throughout this video, we'll break down complex valuation methods, explore the essentials of financial planning, and uncover the principles of controlling. Let's embark on this journey to unlock the secrets behind effective business management and value creation. Company's capital structure is the mix of debt and equity it uses to finance its operations and growth. Striking the right balance is essential, as it impacts both risk and return. Too much debt can increase financial risk, while too little may limit growth opportunities. The optimal capital structure minimizes the company's weighted average cost of capital (WACC) and maximizes its value. By carefully evaluating financing options, businesses can ensure they have the resources needed for expansion while maintaining financial stability. Understanding this balance is the first step toward effective financial management. Return on equity, or ROE, is a key metric that measures a company's profitability relative to shareholder equity. It shows how effectively a business is using its capital to generate profits. The formula for ROE takes into account operating efficiency, leverage, and tax effects. A higher ROE indicates better financial performance and efficient use of capital. However, it's important to compare ROE with industry benchmarks and consider the company's risk profile. By analyzing ROE, stakeholders can assess management's ability to deliver value and make informed investment decisions. Weighted average cost of capital, or WACC, represents the average rate a company pays for its capital from both debt and equity sources. It's a critical figure in financial decision-making, as it serves as the discount rate for evaluating investment projects and business valuations. A lower WACC means cheaper capital, making more projects financially viable. Companies strive to optimize their capital structure to achieve the lowest possible WACC, balancing the costs and benefits of debt and equity financing. Mastering WACC is essential for maximizing firm value. Financial planning is the backbone of any successful business strategy. It involves setting clear objectives, analyzing internal and external factors, and developing both long-term and short-term financial plans. The process starts with defining goals, assessing resources, and choosing the right strategies. A robust financial plan ensures that the company has the necessary funds to achieve its objectives, maintain liquidity, and adapt to changing market conditions. By integrating sales, production, and investment plans, businesses can align their operations and drive sustainable growth. Financial planning process follows a structured approach. It begins with formulating objectives, followed by analyzing the company's internal strengths and external environment. Tools like SWOT analysis, Porter's 5 forces, and PEST analysis help identify opportunities and threats. Next, the company selects a strategy and develops both long-term and short-term financial plans. Implementation is key, as is ongoing monitoring and adjustment to ensure objectives are met. This cyclical process enables businesses to stay agile and responsive in a dynamic market. Financial plans can be divided into strategic long-term and operational short-term components. Strategic plans focus on major investment and financing decisions that shape the company's future. Operational plans, on the other hand, translate these strategies into actionable steps such as annual budgets and cash flow forecasts. By linking strategic and operational plans, businesses ensure that daily activities support long-term objectives. This alignment is crucial for achieving sustainable growth and maintaining financial health. Comprehensive financial plan consists of 3 main components: the income statement, the balance sheet, and the cash flow statement. The income statement projects revenues and expenses, the balance sheet outlines assets and liabilities, and the cash flow statement tracks the movement of funds. Together, these documents provide a holistic view of the company's financial health and guide decision-making. Accurate forecasting and regular updates are essential to keep the plan relevant and actionable. Several methods can be used to develop financial plans. The percentage of sales method estimates future financial needs based on projected sales. Regression analysis uses historical data to predict future trends. Ratio analysis evaluates financial health using key indicators. Break-even analysis identifies the point at which revenues cover costs. Simulation and optimization models help test different scenarios and find the best solution. By combining these methods, companies can create robust and flexible financial plans. Short-term financial planning focuses on the immediate future, typically covering a 1-year period. It involves preparing detailed budgets for sales, purchases, production, and expenses. These budgets help companies manage cash flow, control costs, and respond quickly to changes in the business environment. By breaking down annual plans into monthly or quarterly targets, businesses can monitor progress and make timely adjustments. Effective short-term planning is essential for maintaining liquidity and operational efficiency. Budgeting is a fundamental tool in financial planning. It involves setting targets for revenues, costs, and profits and allocating resources accordingly. Budgets serve as benchmarks for performance evaluation and help identify areas for improvement. Common types of budgets include sales, production, purchasing, and overhead budgets. Regular budget reviews ensure that the company stays on track and can adapt to unforeseen circumstances. By fostering discipline and accountability, budgeting supports effective financial management. Strategic analysis is essential for informed financial planning. Tools like SWOT analysis help identify strengths, weaknesses, opportunities, and threats. Porter's 5 forces examines industry competition, while PEST analysis evaluates political, economic, social, and technological factors. Benchmarking allows companies to learn from industry leaders and adopt best practices. By leveraging these tools, businesses can develop strategies that capitalize on opportunities and mitigate risks. Planning process is a continuous cycle that involves setting objectives, implementing strategies, monitoring results, and making necessary adjustments. It's not just about creating a plan, but also about ensuring its effective execution. Regular reviews and feedback loops help organizations stay aligned with their goals and respond to changes in the market. This dynamic approach to planning fosters resilience and drives long-term success. Business valuation is the process of determining the economic value of a company. It's essential for a variety of purposes, including mergers and acquisitions, investment analysis, and strategic planning. Valuation considers both tangible and intangible assets as well as liabilities. By understanding a company's value, stakeholders can make informed decisions about buying, selling, or restructuring the business. Accurate valuation is the foundation of sound financial management. Business valuation can be performed at different levels. The gross value, or brutto, includes both owners and creditors, while the net value, or netto, focuses on the owner's equity after deducting liabilities. Understanding these distinctions is important for selecting the appropriate valuation method and interpreting results. The choice of level depends on the purpose of the valuation and the needs of the stakeholders involved. There are many reasons to conduct a business valuation. These include preparing for a sale or acquisition, merging with another company, restructuring, or changing the legal form of the business. Valuation is also necessary for resolving disputes, securing financing, or complying with regulatory requirements. By understanding the motivations behind valuation, companies can choose the most suitable methods and achieve their objectives effectively. Process of business valuation involves several key steps. First, the purpose and scope of the valuation are defined. Next, a strategic and financial analysis is conducted to assess the company's position and prospects. The appropriate valuation methods are then selected and applied. Finally, the results are interpreted and presented to stakeholders. This systematic approach ensures that the valuation is objective, transparent, and reliable. Income-based valuation methods focus on the company's ability to generate future profits or cash flows. The most common approach is the discounted cash flow (DCF) method, which estimates the present value of expected future cash flows. Other methods include the economic value added (EVA) approach and the capitalization of earnings. These methods are widely used because they reflect the company's earning potential and growth prospects. Discounted cash flow (DCF) method is a cornerstone of business valuation. It calculates the present value of a company's future free cash flows discounted at the appropriate rate, usually the WACC. The DCF method can be applied using different models, such as the entity approach, equity approach, or adjusted present value (APV) approach. By projecting future cash flows and discounting them to today's value, DCF provides a comprehensive measure of a company's intrinsic worth. Economic value added (EVA) approach measures a company's true economic profit by deducting the cost of capital from its net operating profit after taxes. EVA highlights whether a company is creating or destroying value for its shareholders. The valuation model based on EVA combines the invested capital with the present value of future EVA. This method is particularly useful for evaluating management performance and identifying value drivers within the business. Capitalization of earnings method estimates a company's value based on its historical earnings, adjusted to reflect ongoing profitability. This approach is particularly useful for stable businesses with predictable income streams. By dividing the adjusted earnings by capitalization rate, the method provides a straightforward estimate of value. However, it's important to consider industry trends and future prospects when applying this method. Cash flow return on investment (CFROI) model separates the value of existing assets from the value of future investments. It calculates the company's value as the sum of the present value of current assets and the present value of expected future investments. This approach is particularly useful for companies with significant growth opportunities, as it highlights the contribution of new investments to overall value. Market-based valuation methods estimate a company's value by comparing it to similar businesses or recent transactions in the market. These methods are particularly useful when there is a well-developed market for comparable companies. Common approaches include the comparable company analysis, precedent transaction analysis, and market capitalization. By using market data, these methods provide a reality check for other valuation approaches. Comparable company analysis involves selecting a group of similar businesses and comparing key financial metrics, such as price to earnings, PE ratios, price to cash flow, and price to sales. The goal is to estimate the subject company's value based on how the market values similar firms. This method requires careful selection of comparables and adjustment for differences in size, industry, and financial structure. Precedent transaction analysis looks at recent sales of similar companies to determine valuation multiples. By examining the prices paid in actual transactions, this method provides insight into what buyers are willing to pay in the current market. It's important to consider the context of each transaction, such as market conditions and deal structure, to ensure accurate comparisons. Valuation multiples, such as the PE ratio, are widely used in market-based valuation. These ratios compare a company's market price to key financial indicators, providing a quick estimate of value. It's essential to select appropriate multiples and adjust for industry trends, company size, and growth prospects. Market-based methods work best in transparent markets with reliable data and active trading. Asset-based valuation methods focus on the value of a company's tangible and intangible assets. These methods are particularly relevant for asset-intensive businesses or companies facing liquidation. Common approaches include book value, liquidation value, and replacement cost. By analyzing the company's balance sheet and adjusting for market conditions, asset-based methods provide a solid foundation for valuation. Book value represents the company's net worth based on historical costs, while liquidation value estimates the proceeds from selling assets and settling liabilities. These values provide a baseline for valuation, especially in distressed situations. However, they may not reflect the company's true earning potential or market value, so they are often used in conjunction with other methods. Substance value approach determines a company's value based on the replacement cost of its assets, minus depreciation and liabilities. This method answers the question, how much would it cost to rebuild the business from scratch? It's especially useful for companies with significant physical assets. By focusing on asset values, this approach provides a conservative estimate of worth. Valuing real estate and equipment requires specialized methods. For real estate, the comparative method uses recent sales of similar properties, while the cost method estimates replacement cost minus depreciation. For equipment, technical value and market value are considered, taking into account age, condition, and market demand. Accurate asset valuation is crucial for businesses with significant property, plant, and equipment. Tangible assets such as patents, trademarks, and goodwill can represent significant value for a business. Valuing these assets often involves market, income, or cost approaches. Methods include the relief from royalty method, incremental income method, and residual value method. Proper valuation of intangibles is essential for technology-driven and brand-focused companies. Receivables and inventory are important components of working capital. Short-term receivables are valued based on collectability, while long-term receivables consider the likelihood of recovery. Inventory is valued at replacement cost or liquidation value, depending on its necessity for operations. Accurate valuation of these assets ensures a realistic assessment of the company's financial position. After applying multiple valuation methods, it's important to interpret the results carefully. Avoid simply averaging the outcomes, instead assign weight to each method based on its relevance and data quality. The final valuation should reflect the company's unique characteristics, market conditions, and strategic outlook. This balanced approach ensures a fair and credible result for all stakeholders. Controlling is a management philosophy focused on systematic planning, monitoring, and steering of business activities. It's not just about control or auditing, but about supporting decision-making and ensuring the company achieves its objectives. Controlling integrates planning, reporting, and analysis to provide actionable insights and drive continuous improvement. Controlling plays a vital role in aligning business activities with strategic goals. It involves setting targets, monitoring performance, analyzing deviations, and implementing corrective actions. By providing timely and relevant information, controlling helps managers make informed decisions and adapt to changing circumstances. This proactive approach supports long-term success and organizational resilience. Controlling originated in the United States in the late 19th century and has evolved significantly over time. Early systems focused on cost accounting and internal controls. Today, controlling encompasses a wide range of activities, from strategic planning to performance measurement. In Central Europe, controlling gained prominence with the adoption of modern management practices and the influence of international corporations. Implementing controlling brings numerous benefits, such as improved planning accuracy, better resource allocation, and enhanced decision-making. It also increases transparency and accountability within the organization. However, challenges include resistance to change, limited resources, and the need for reliable data. Overcoming these barriers requires strong leadership and a commitment to continuous improvement. Future of controlling is shaped by technological innovation, increasing competition, and the need for agility. Trends include the adoption of advanced analytics, process-oriented management, and decentralized decision-making. Modern concepts like beyond budgeting and balanced scorecard are gaining traction. As businesses face new challenges, controlling will continue to evolve, supporting strategic and operational excellence. Controlling is guided by several key principles: future orientation, goal alignment, focus on critical success factors, and activity-based management. It emphasizes systematic planning, continuous monitoring, and proactive intervention. By adhering to these principles, organizations can achieve sustainable growth and adapt to changing environments. Core tasks of controlling include setting objectives, forecasting, planning, comparing actual results with plans, analyzing deviations, and implementing corrective measures. These activities form a continuous cycle that drives organizational improvement. By systematically addressing each task, controlling ensures that the company remains on course to achieve its strategic goals. Effective controlling system must include comprehensive planning and control processes, management-oriented accounting, and robust reporting systems. It should provide timely, accurate, and relevant information to support decision-making. Automation and integration with other business systems enhance efficiency and data quality. Meeting these requirements is essential for successful controlling implementation. Controlling cycle consists of planning, quantifying deviations, implementing corrective actions, and analyzing results. This iterative process ensures continuous improvement and alignment with organizational goals. By regularly reviewing performance and making necessary adjustments, companies can stay agile and responsive in a dynamic business environment. Controlling utilizes a variety of tools and methods, including reporting systems, OLAP, business intelligence, budgeting, and cost calculation techniques like ABC and target costing. Investment appraisal methods such as NPV, IRR, and EVA are also commonly used. Benchmarking and process analysis help identify best practices and areas for improvement. Leveraging these tools enhances the effectiveness of controlling. Modern controlling concepts include process-oriented management, value-based management, and the use of balanced scorecard. These approaches emphasize alignment with strategic objectives, integration of financial and non-financial metrics, and continuous process improvement. By adopting modern concepts, companies can enhance their competitiveness and drive long-term value creation. Let's start by understanding what controlling really means and why it's a cornerstone for successful enterprises. Controlling is built on a systematic, goal-oriented philosophy. It's about looking ahead, focusing on profit, and securing the company's long-term future. This approach means reacting proactively to changes in the business environment and always keeping the organization's objectives in sight. By aligning all activities with strategic goals, controlling ensures that every decision supports the company's mission and vision. Main tasks of controlling span from planning and coordination to reporting and evaluation. Controllers design planning systems, coordinate planning activities, and manage certain business operations. They also handle reporting, interpretation of financial data, and provide advice on planning, management, and control. Additionally, controllers oversee tax matters, asset protection, and even contribute to economic research. Their role is multifaceted and crucial for organizational success. Controlling involves a series of recurring activities: setting goals, forecasting, planning, comparing plans with reality, analyzing deviations, implementing corrective actions, and setting new objectives. This cycle ensures continuous improvement and adaptation. By regularly reviewing performance and making adjustments, organizations can stay agile and responsive to both internal and external changes. Controller acts as a coordinator, advisor, and navigator within the company. They are equal partners to management, holding economic authority and ensuring transparency of results. However, controllers don't make all the decisions themselves. Instead, they facilitate informed decision-making by providing accurate data and insightful analysis. Their expertise bridges the gap between strategy and operation. Robust controlling system is grounded in several core principles: business planning, internal control, company management, and scenario creation. Planning anticipates future activities and involves making decisions that affect the entire business process. Scenario planning helps organizations prepare for various possible futures, enhancing resilience and strategic flexibility. Strategic planning is a key function of controlling. It involves analyzing strategic gaps, forecasting future orders, and converting tasks into financial units through budgeting. By examining strengths and weaknesses and establishing early warning systems, controllers help organizations stay ahead of potential risks and capitalize on opportunities. Operational planning focuses on costs, revenues, and profit. Controllers use tools like investment planning and performance budgeting to ensure efficient resource allocation. This level of planning is essential for day-to-day management and achieving short-term business objectives, keeping the company on track toward its strategic goals. Financial planning is crucial for managing liquidity and ensuring the company can meet its financial obligations. It includes liquidity plans, capital movement balances, and financing plans. By maintaining a clear overview of financial flows, controllers help safeguard the company's financial health and stability. Planned balance sheets are developed from initial balances, projected capital movements, and analysis of individual balance components. This process provides a forward-looking view of the company's financial position, supporting better decision-making and risk management. Calculating planned costs involves estimating quantities, prices, and utilization rates for both personnel and machinery. Cost forecasting is ideally done analytically at the cost center level, using planned capacities and standard prices. When analytical planning isn't possible, historical data is used as a basis for future projections. Performance forecasting sums up all calculated order volumes and deducts the resources needed to generate these outputs. This provides a comprehensive result for the company relating to specific orders. Flexible budgeting is essential to adapt to changing assumptions and ensure accurate performance measurement. Modern controlling emphasizes identifying and addressing business bottlenecks, focusing on the future, and working with analytically derived standards. Controllers must be flexible, proactive, and motivated to implement even unpopular corrective measures when necessary. This approach ensures the company remains competitive and resilient. Controllers concentrate on the most pressing issues within the company. They must quickly identify where problems lie, analyze the situation, propose appropriate corrective actions, and ensure these measures are implemented in collaboration with relevant departments. This requires high personal commitment and motivation. A key aspect of modern controlling is future-oriented planning. This involves building short-term, medium-term 3-5 years, and long-term 5-10 years plans. Strategic planning doesn't always have a fixed time horizon but focuses on ensuring the company's ongoing existence and success. Comparing actual results with planned targets is essential for future-oriented, progressive thinking. This comparison allows organizations to register and analyze past events, forming the basis for corrective actions and continuous improvement. Past performance provides valuable information for future measures to secure company goals and existence. Analyzing deviations from past plans leads to corrective actions, while rolling annual and medium-term planning allows for consideration of both internal and external data changes. Standards in controlling are analytically derived criteria for various business activities. Building a normative base and a system of standards is fundamental for effective operational management within controlling. These standards guide daily operations and ensure consistency across the organization. The organizational structure of controlling often includes both line and staff positions. Controllers work closely with various departments, ensuring that standards and processes are consistently applied throughout the company. This structure supports effective communication and implementation of controlling measures. Information systems play a vital role in supporting controlling activities. Controllers rely on integrated information systems to access financial, managerial, and operational data. These systems provide the foundation for accurate reporting, analysis, and decision-making. Controllers gather information from various sources: financial accounting, cost and managerial accounting, strategic management, and internal company standards. This diverse data pool ensures that controlling decisions are well-informed and comprehensive. Controlling information is used by both internal and external stakeholders. Internally, management, owners, and employees at various levels rely on these insights. Externally, suppliers, customers, banks, creditors, government agencies, and the public may also require structured, problem-focused information. Controlling information system integrates accounting and controlling data, clearly distinguishing between cost and revenue variables. It assigns goals and results to specific departments or projects, providing detailed information on organizational units, products, projects, and investments. Modern controlling systems combine transaction processing systems (TPS), management information systems (MIS), executive information systems (EIS), and controlling information systems (CIS). This integration supports comprehensive data analysis and effective decision-making at all management levels. Reporting systems must focus on the recipient, highlight key indicators, and clearly show the contribution and success of each department. Timeliness and relevance are essential, ensuring that decision-makers always have up-to-date and actionable information. Modern solutions for controlling include comparing actual and planned results using past experiences and streamlining the planning process. These approaches enhance the ability to respond quickly to changes and improve the overall effectiveness of controlling activities. Reporting is a fundamental function of controlling, creating a comprehensive system of indicators and information. Reports evaluate not only the overall development of the company but also its individual parts, providing crucial insights for management decisions. Building a reporting system involves several steps: drafting the system, discussing it with relevant departments, planning cost types, establishing cost center records, and creating documentation. Regular testing and updates ensure the system remains effective and relevant. Reporting can be standard or extraordinary. Standard reports are routine, produced at regular intervals with a predefined structure. Extraordinary reports are created on demand, either following the standard structure or tailored to specific needs and situations. There is a close relationship between reporting and marketing. Accurate and timely reports provide marketing teams with the data they need to make informed decisions, track performance, and adjust strategies to meet market demands. Controller reports should be clear, concise, and focused on the recipient's needs. They must have a clear purpose, consistent structure, and provide a straightforward interpretation of key indicators, often using graphical representations for clarity. Routine controller reports include monthly comparisons of plans and actuals, personnel costs, sales by product and channel, investment status, and financial plans. These reports must contain detailed commentary on each data point, ensuring transparency and actionable insights. Common mistakes in controlling reports include failing to identify the user, not focusing on key financial indicators, lengthy passages that distract from the main message, and inconsistent reporting styles. Quick orientation and logical structure are essential for effective communication. Reports should always be tailored to the recipient, focusing on the essence of the matter. Use simple, clear language and maintain a logical structure. Graphical representations help users quickly understand the information, and a unified style ensures easy comparison and orientation. The frequency and content of reports depend on the company's needs. Standard reports are usually monthly, quarterly, or annually, but can also be weekly or biweekly if required. Extraordinary reports are produced as needed, either following the standard structure or with unique content. Deviation analysis is a key tool in controlling. It involves analyzing differences between planned and actual results, identifying causes, and proposing corrective measures. This process helps reduce the likelihood of future deviations and supports continuous improvement. Comparing plans with reality and analyzing deviations provides valuable feedback. Controllers use this feedback to design corrective actions, ensuring that the company adapts to changes and stays on course to achieve its objectives. The response to deviations depends on their size. Small deviations are handled by specialized departments, medium deviations involve the controller and departments working together, and large deviations require the involvement of top management. This tiered approach ensures appropriate action at every level. Statistical data is crucial for evaluating economic performance, enabling international comparisons, and supporting government policy decisions. It also informs business planning and investment decisions, making it an essential resource for both public and private sectors. Statistical reports can be monthly, quarterly, semi-annual, or annual, and sometimes cover longer periods. They provide insights into employment, education, consumption, and other key factors, supporting both business and government decision-making. Certain organizations are legally required to provide statistical data to government agencies. This obligation ensures that accurate, comprehensive data is available for economic analysis and policymaking. Non-compliance can result in significant penalties. Local governments maintain records of key indicators for planning and revenue purposes. They also keep various records as required by law, such as waste management, accommodation capacities, and gaming machine fees. This data supports local planning and administration. Companies fulfill their tax reporting obligations through accounting, providing necessary data for various tax requirements. Different taxes require different data, and companies must ensure timely and accurate reporting to tax authorities and other relevant institutions. Each organization must assign responsibility for reporting based on its structure. In smaller firms, accountants often handle reporting duties, while larger companies may have dedicated controlling departments. This ensures that all reporting obligations are met efficiently and accurately. Operative controlling focuses on the short-term management of a company's resources and processes. It is all about ensuring that daily operations align with the company's plans and objectives. By monitoring key metrics and quickly addressing deviations, operative controlling helps businesses react promptly to challenges and opportunities. This approach emphasizes the importance of timely corrective actions, especially when actual performance strays from the set plan. The main aim is to optimize material, time, and value parameters, ensuring efficiency and profitability in the short run. Core tasks of operative controlling include planning, monitoring, and analyzing business activities. It involves setting up budgets, forecasting outcomes, and regularly comparing actual results with planned figures. When discrepancies arise, operative controlling provides the tools and information needed to implement corrective measures. This ensures that the company remains agile and responsive. Additionally, operative controlling supports internal accounting and calculations, processes data for decision-making, and helps resolve operational bottlenecks. By providing timely information, it empowers management to steer the company effectively. Operative controlling relies on a set of practical tools to manage and optimize business performance. These include planned balance sheets, profit and loss forecasts, financial plans for liquidity management, and performance budgets. Each tool serves a specific purpose, from tracking capital flows to calculating costs and results for different periods. By integrating these instruments, companies can gain a holistic view of their financial health and make informed decisions. The use of these tools is essential for effective short-term management and achieving operational targets. Fundamental concept in controlling is the classification of costs into fixed and variable categories. Fixed costs remain constant regardless of production volume, such as salaries for management or rent. Variable costs, on the other hand, fluctuate with output, including materials, wages, and energy. Understanding this distinction is crucial for budgeting, pricing, and profitability analysis. By accurately categorizing costs, companies can better predict financial outcomes and identify areas for improvement. Fixed costs are those expenses that do not change with the level of production or sales. Common examples include financing and accounting costs, salaries for administrative staff, and costs related to company management. These costs are predictable and must be covered regardless of business activity. Properly managing fixed costs is essential for maintaining financial stability, especially during periods of low sales or production. Variable costs change directly with the volume of production. These include costs for raw materials, packaging, production wages, commissions, electricity, and transportation. As production increases, so do these expenses. Monitoring variable costs helps companies adjust pricing strategies and maintain profitability. By keeping a close eye on these costs, businesses can respond quickly to market changes and optimize their operation. Short-term economic results are calculated by analyzing both revenues and costs over a specific period. This process involves tracking gross sales, deducting variable costs, and then subtracting fixed costs to determine the operating profit. By breaking down these figures, companies can identify which products or services contribute most to profitability and where improvements are needed. This calculation is vital for day-to-day decision-making and long-term planning. Contribution margin is a key metric in controlling, representing the amount left after variable costs are deducted from sales. This figure is used to cover fixed costs and generate profit. If the contribution margin exceeds fixed costs, the company makes a profit. Otherwise, it may face losses. Understanding and optimizing the contribution margin helps businesses set prices, control costs, and improve overall profitability. Break-even point is where total revenues equal total costs, meaning the business neither makes a profit nor incurs a loss. This critical threshold helps managers understand the minimum sales needed to cover all expenses. By calculating the break-even point, companies can set realistic sales targets and make informed decisions about pricing, production, and cost management. Multi-level cost calculation involves breaking down costs into several layers, such as direct costs, group costs, and company-wide costs. This approach allows for more precise allocation of expenses and better insight into which areas of the business are most profitable. By analyzing costs at different levels, companies can identify inefficiencies and target improvements more effectively. Cost centers are organizational units responsible for managing and controlling costs within a company. These can include production departments, sales teams, or administrative units. By assigning costs to specific centers, businesses can monitor spending, evaluate performance, and encourage accountability. This structure supports more effective budgeting and resource allocation. There are several types of cost centers, each with a unique focus. Expense centers concentrate on controlling costs, revenue centers focus on maximizing income, profit centers manage both costs and revenues, and investment centers handle decisions about capital allocation. Understanding these distinctions helps companies assign responsibilities and measure performance accurately. Costs can be classified in various ways, such as by function, purpose, or responsibility. Functional classification groups costs by business activity, like production or administration. Purpose-based classification links costs to specific products or projects. Responsibility classification assigns costs to departments or managers. These methods provide valuable insights for decision-making and performance evaluation. Managerial accounting plays a crucial role in controlling by providing detailed financial information for decision-making. It supports both short-term and long-term planning, helping managers evaluate different scenarios and choose the most effective strategies. Managerial accounting also aids in budgeting, forecasting, and analyzing variances between planned and actual results. Cost volume profit (CVP) analysis examines how changes in costs and sales volume affect a company's profit. By understanding the relationship between fixed and variable costs, sales price, and output, managers can make informed decisions about pricing, production levels, and product mix. CVP analysis is a powerful tool for strategic planning and risk management. Scenario analysis involves evaluating different possible future outcomes based on varying assumptions. This technique helps companies prepare for uncertainties and make better strategic decisions. By modeling best case, worst case, and most likely scenarios, managers can assess potential risks and opportunities, ensuring the company is ready to adapt as needed. Financial controlling is a subsystem of business controlling, focused on ensuring liquidity and financial stability. It involves identifying financial bottlenecks, allocating resources efficiently, and monitoring the company's financial environment. Financial controlling also includes planning, managing, and minimizing costs associated with securing financial resources. Main functions of financial controlling include acquiring financial resources, allocating them to business activities, and managing reserves. It also covers decisions about profit distribution and maintaining financial equilibrium. By overseeing these areas, financial controlling helps companies avoid liquidity problems and support sustainable growth. Financial controlling tasks include early identification of financial issues, forecasting constraints, setting financing principles, and implementing preventive measures to ensure payment ability and financial balance. Regular financial analysis and reporting are crucial for maintaining transparency and supporting decision-making at all levels of the organization. Financial controlling utilizes a variety of tools such as liquidity management, working capital control, financial analysis, planning, and investment controlling. These instruments help companies monitor cash flow, manage debts and receivables, and ensure that investments align with strategic goals. Effective use of these tools is essential for financial health. Maintaining adequate liquidity is vital for any business. Liquidity management ensures that the company can meet its short-term obligations, pay suppliers and employees, and avoid financial distress. However, holding too much cash can reduce efficiency and profitability. Striking the right balance is key to effective liquidity management. Working capital control focuses on managing the company's current assets and liabilities. This includes monitoring inventory, receivables, and payables to ensure smooth operations. Effective working capital management helps companies avoid cash shortages, reduce financing costs, and improve profitability. Receivables controlling involves monitoring outstanding customer payments and managing credit risk. By evaluating payment terms, tracking overdue accounts, and taking timely action, companies can minimize bad debts and improve cash flow. This process also includes setting credit limits and maintaining accurate customer records. Inventory controlling is about managing stock levels to balance supply and demand. Holding too much inventory ties up capital and increases storage costs, while too little can disrupt production. By analyzing inventory turnover and optimizing order quantities, companies can reduce costs and maintain efficient operations. Payables controlling ensures that the company meets its short-term obligations without jeopardizing liquidity. This involves managing payment schedules, negotiating favorable terms with suppliers, and avoiding late fees. Efficient payables management supports good supplier relationships and financial stability. Financial planning is a complex and time-consuming process that aims to positively influence the company's financial situation and reduce risks. It involves gathering information from various business plans, forecasting cash flows, and setting financial targets. Both long-term and short-term plans are essential for guiding the company's financial decisions. Long-term financial planning focuses on strategic decisions with lasting impact, such as investments and capital structure. Short-term planning, on the other hand, deals with day-to-day cash management and meeting immediate financial obligations. Both are crucial for maintaining financial health and achieving business objectives. Investment controlling involves evaluating, managing, and monitoring company investments. This process assesses the profitability and risks of different investment projects, helping managers decide where to allocate resources. By using financial metrics like NPV and IRR, companies can make informed investment decisions that support long-term growth. Financial controlling relies on key indicators to assess the company's financial structure and performance. These include debt ratios, asset utilization, and profitability measures like ROA and ROE. Regularly monitoring these indicators helps companies identify strengths and weaknesses, guiding strategic decisions. Understanding the company's capital structure is essential for managing financial risk. This involves analyzing the mix of equity and debt, assessing the availability of long-term and short-term funds, and ensuring that assets are financed appropriately. A balanced capital structure supports stability and growth. Profitability analysis examines how effectively a company generates profit from its resources. Key metrics include return on assets (ROA) and return on equity (ROE). By analyzing these figures, companies can evaluate their financial performance and identify opportunities to improve efficiency and returns. Cash flow management tracks the movement of money in and out of the business. By forecasting cash inflows and outflows, companies can ensure they have enough liquidity to meet obligations and invest in growth. Effective cash flow management reduces the risk of financial shortfalls and supports long-term stability. Variance analysis compares actual financial results with planned figures to identify deviations. By understanding the reasons behind these variances, companies can take corrective actions and improve future performance. This process is essential for maintaining control and achieving financial targets. Budgeting is a cornerstone of controlling, providing a financial roadmap for the company. It involves setting spending limits, forecasting revenues, and allocating resources to different departments. Regular budget reviews help ensure that the company stays on track and adapts to changing circumstances. Transparent reporting is vital for effective controlling. Regular financial reports provide stakeholders with up-to-date information on the company's performance, enabling informed decision-making. Consistent reporting also builds trust and accountability throughout the organization. Risk management is an integral part of controlling, helping companies identify, assess, and mitigate potential threats to financial stability. By analyzing risks related to liquidity, investments, and operations, businesses can develop strategies to minimize negative impacts and seize opportunities. Internal controls and audits ensure that financial processes are reliable and compliant with regulations. Regular audits help detect errors, prevent fraud, and maintain the integrity of financial information. Strong internal controls are essential for safeguarding company assets and supporting sound decision-making. Strategic controlling focuses on long-term goals and overall direction, while operative controlling deals with short-term actions and immediate results. Both are necessary for business success. Strategic controlling sets the vision, and operative controlling ensures that daily activities align with that vision. Continuous improvement is at the heart of effective controlling. By regularly reviewing processes, analyzing results, and implementing changes, companies can enhance efficiency, reduce costs, and stay competitive. This mindset encourages innovation and adaptability in a rapidly changing business environment. Modern controlling relies heavily on information systems to collect, process, and analyze data. These systems provide real-time insights, automate reporting, and support decision-making. Investing in robust information technology is essential for efficient and effective controlling. Continuous training and development of staff are crucial for maintaining high standards in controlling. By keeping up with the latest tools, techniques, and regulations, employees can contribute more effectively to the company's financial health and strategic goals. Effective communication is essential for successful controlling. Clear and timely sharing of information ensures that everyone in the organization understands financial goals, current performance, and necessary actions. Good communication fosters collaboration and supports a culture of accountability. The business environment is constantly evolving, and controlling must adapt accordingly. This means staying alert to market trends, regulatory changes, and technological advancements. By remaining flexible and proactive, companies can turn challenges into opportunities and maintain a competitive edge. Welcome to our comprehensive guide on mastering financial control in business. In today's fast-paced and competitive environment, effective financial management is the backbone of every successful organization. This video will walk you through the essential principles, strategies, and tools needed to ensure your company's financial stability and growth. We'll explore everything from debt management and liquidity planning to strategic controlling and process optimization. Whether you're a business owner, manager, or finance professional, understanding these concepts will empower you to make informed decisions and drive your company forward. Let's begin by setting the stage for why financial control is so crucial. Liquidity is the lifeblood of any business. Ensuring that your company has enough cash on hand to meet its short-term obligations is vital for survival and growth. A balanced approach to managing both income and expenses in the short and long term helps maintain financial health. By regularly monitoring cash flows and anticipating future needs, businesses can avoid the pitfalls of insolvency and seize new opportunities as they arise. In this scene, we'll discuss the key factors that influence liquidity and how to keep your finances in check. Managing debt effectively is a cornerstone of sound financial control. This involves monitoring both medium-term and long-term liabilities, as well as planning and controlling short-term debt. By establishing clear repayment schedules and aligning them with your company's cash flow, you can minimize financial risks. It's also important to set up reserves to ensure payment capability and to plan for future loans strategically. Let's explore the best practices for keeping your company's debt under control and maintaining financial equilibrium. Achieving financial balance requires careful planning of both income and expenses across different time periods. This means preparing detailed budgets for various planning horizons and ensuring that your company's financial resources are optimally allocated. By doing so, you can minimize costs and maximize the efficiency of your financial sources. Regularly reviewing and adjusting your plans in response to changing circumstances is key to maintaining stability and supporting long-term growth. Critical aspect of financial control is ensuring your business can always meet its payment obligations. This involves not only maintaining sufficient cash reserves, but also implementing measures to safeguard liquidity. By anticipating potential shortfalls and having contingency plans in place, you can protect your company from unexpected financial shocks. Let's look at how to build and maintain a robust payment capability strategy. Medium-term financial planning bridges the gap between daily operations and long-term strategy. It includes investment planning, cash flow forecasting, and ensuring financial coverage for ongoing activities. By projecting your company's needs over the next few years, you can make informed decisions about investments, funding, and resource allocation. This proactive approach helps sustain growth and prepares your business for future challenges. Investment asset planning focuses on managing changes in tangible assets and the development of financial investments. By carefully evaluating potential investments and their impact on your company's balance sheet, you can ensure that resources are directed toward projects with the highest returns. This scene will guide you through the process of assessing investment opportunities and aligning them with your overall financial strategy. Managing working capital is essential for maintaining smooth business operations. This involves planning for inventory, unfinished production, finished goods, and receivables. By optimizing your working capital, you can ensure that your company has the resources it needs to operate efficiently without tying up unnecessary funds. Let's explore the best practices for managing working capital and supporting your company's day-to-day needs. Financial coverage planning ensures that your company has access to the necessary funds to support its operations and investments. This includes evaluating the suitability of loans, setting targets for equity contributions, and planning for increases in company capital. By diversifying your funding sources and maintaining a healthy balance between debt and equity, you can strengthen your company's financial foundation. Regularly comparing your financial plans with actual results is crucial for effective control. This process helps identify variances, understand their causes, and implement corrective actions. By tracking key indicators such as operating results, cash flow, and payment capability, you can ensure that your business stays on course and adapts quickly to changing conditions. Managing daily income is a vital part of maintaining liquidity. The goal is to avoid delays in payments and the resulting penalties. Ensuring that your daily cash position is always greater than or equal to your due expenses helps keep your business running smoothly. In this scene, we'll discuss practical steps for monitoring and optimizing daily income flows. Effective liquidity management requires a set of guiding principles. These include avoiding delays in settling obligations, maintaining optimal account balances, using credit limits wisely, and preventing losses from idle funds. By regulating the speed of cash flows, accelerating income, and slowing down expenses, you can maximize your company's financial flexibility and resilience. Cash position is a key component of financial controlling. It encompasses planning, execution, and control activities that follow each other rapidly within defined periods. The focus is on verifying expected cash flows, checking account balances, and ensuring optimal use of financial resources. Let's delve into how to manage your cash position effectively for better financial outcomes. Payment instruments such as collection orders, credit notes, payment advices, and bills of exchange play a crucial role in daily financial operations. Proper management of these tools ensures timely collections and payments, supporting overall liquidity. This scene will guide you through the best practices for handling various payment instruments efficiently. Controlling daily expenses is just as important as managing income. This includes obligations to suppliers, bills of exchange, issued checks, annuities, interest payments, personnel costs, and taxes. By keeping a close eye on these outflows, you can maintain a healthy cash balance and avoid unexpected shortfalls. Let's look at strategies for effective daily expense management. Short-term liquidity control involves deciding whether to keep funds in current accounts, invest in securities, or place surpluses in term deposits. Supporting sales through early payments with bonuses can also improve liquidity. Having accurate information about future cash flows and market conditions is essential for making the right decisions. Let's explore how to optimize short-term liquidity. Short-term financial deficits arise due to unsynchronized income and expenses. Businesses must act quickly. Options include using liquidity reserves, obtaining short-term external funds, accelerating income, or adjusting company plans. The main advantage of short-term sources is their flexibility, but they also come with higher risks. Let's discuss how to respond effectively to short-term deficits. Short-term funding offers flexibility and quick access to resources, making it easier to respond to liquidity shortages or surpluses. However, these sources usually come with lower costs but higher risks, such as increased chances of insolvency. Understanding the trade-offs between flexibility and risk is essential for effective financial management. Companies can obtain short-term funds either spontaneously through operations, such as supplier credits, delayed payroll, or customer advances, or beyond these sources through bank loans, discount loans, and factoring. The availability of short-term funds may be limited by factors like company indebtedness, inability to provide guarantees, or poor financial results. Let's examine the main sources and their implications. Understanding the structure of assets and their funding sources is fundamental for financial control. This includes analyzing the balance sheet, identifying financial needs, and matching them with appropriate sources. By aligning long-term and short-term assets with suitable funding, companies can optimize their capital structure and support sustainable growth. Banking control is a specialized area of financial management, focusing on the unique aspects of banking operations. This includes managing assets and liabilities, classifying risk, creating reserves, and ensuring operational efficiency. Effective banking control supports profitability and risk management in a highly regulated environment. Banks primarily hold financial assets such as loans and securities, with a small portion in tangible assets like buildings and equipment. On the liability side, banks rely heavily on short-term deposits and external financial resources. Understanding this structure is key to managing liquidity and profitability in the banking sector. Banking transactions can be classified as active, providing loans, passive, accepting deposits, or neutral, service fees. Each type plays a distinct role in the bank's operations and profitability. By managing these transactions effectively, banks can optimize their income streams and control risks. Banks generate profits mainly through interest received on loans, returns from securities, and service fees. Effective management of these income sources, along with cost control, is essential for maintaining profitability in a competitive market. Let's explore how banks maximize their earnings. Effective bank management involves analyzing the balance sheet structure, classifying loan risks, and managing liabilities. Operational efficiency and cost control are also critical. By focusing on these areas, banks can enhance their resilience and adapt to changing market conditions. The banking sector is experiencing significant trends such as consolidation, mergers and acquisitions, cost reduction, and diversification of income sources. The adoption of new technologies and the globalization of banking activities are also shaping the industry's future. Staying ahead of these trends is crucial for long-term success. Bank controlling involves using macroeconomic forecasts, comparing planned and actual values, and analyzing deviations. This helps banks make informed decisions, manage risks, and improve performance. Let's look at the main tasks and responsibilities of bank controllers. Banks often operate with a matrix structure, including headquarters, branches, and subsidiaries. This allows for efficient management of resources and expertise. Participation in business planning and budgeting is a key function, supported by specialists from the central office. Banks segment their markets and tailor strategies to specific client groups. Often, a small percentage of clients generate the majority of profits. Product strategies such as housing loans or electronic banking are designed to meet the needs of different customer segments. Strategic controlling in banking focuses on portfolio management, balance sheet structure, and budget management. By aligning these elements with long-term goals, banks can ensure sustainable growth and profitability. This scene explores the tools and methods used in strategic bank controlling. Operational controlling tracks the profitability of individual transactions, assesses risks, and monitors service costs. It also evaluates the contribution of products, customer groups, and sales channels to overall performance. Effective operational controlling supports day-to-day decision-making and risk management. Banks face various risks, including market risk, interest rate risk, credit risk, liquidity risk, capital risk, and operational risk. Each type requires specific management strategies to minimize potential losses and ensure stability. Understanding these risks is essential for effective bank management. Strategic controlling (SC) is about ensuring the long-term prosperity of a company. It involves analyzing internal strengths and weaknesses, monitoring strategic goals, and preparing measures to address deviations. SC uses tools like SWOT analysis, logistics, and quality management to guide the company toward sustainable success. There are several approaches to strategic controlling, including market-oriented, resource-oriented, value-oriented, and comprehensive methods. Each approach offers unique perspectives and tools for achieving long-term business objectives. Choosing the right approach depends on your company's goals and environment. The main goal of strategic controlling is to ensure that today's actions contribute to the company's future existence and success. This involves creating conditions for future operational results and preparing the ground for achieving them. Strategic controlling is proactive, focusing on long-term sustainability. Strategic controlling uses a variety of tools and methods such as SWOT analysis, logistics, product life cycle analysis, total quality management, and value-based management. These tools help companies analyze their environment, identify opportunities and threats, and develop effective strategies. Portfolio analysis and market analysis are essential for strategic controlling. They help companies assess their position in the market, understand competitors, and identify strategic gaps. By using these analyses, businesses can make informed decisions about where to invest and how to grow. Process controlling focuses on continuously improving business processes to meet customer demands and stay competitive. By optimizing quality and reducing costs, companies can enhance their performance and maintain an edge in the market. Process controlling involves planning, monitoring, and refining every step of the workflow. The main function of process controlling is to shape the planning and control system and implement it at all levels of the company. This ensures that every department is aligned with the overall strategy and that processes are consistently monitored and improved. Process management uses knowledge, experience, tools, and systems to define, visualize, measure, control, inform, and improve processes. The goal is to meet customer requirements while optimizing profitability. Let's explore the techniques that drive effective process management. Activity-based management (ABM) identifies and evaluates activities that add value within business processes. It serves as a foundation for re-engineering and optimizing company workflows. By focusing on value-creating activities, businesses can improve efficiency and profitability. Measuring performance involves collecting and analyzing information about the achievement of company goals and plans. Methods include activity-based costing, ABC, balanced scorecard, BSC, benchmarking, and Six Sigma. These tools help identify areas for improvement and track progress over time. Software tools play a vital role in supporting process controlling. They enable companies to measure, analyze, and optimize business processes as they occur within the information system. By leveraging technology, businesses can gain real-time insights and drive continuous improvement. Controlling extends to all functional areas including production and personnel management. In production, it covers everything from order processing to delivery, focusing on transparency, continuous improvement, and strategic decision-making. In personnel management, controlling ensures the right employees are in place at the right time and cost. Let's start by understanding why financial performance matters and how it impacts strategic business decisions. Investors are constantly seeking opportunities that provide a competitive edge. Their motivation often revolves around investments that can lower production costs, drive innovation, and leverage advanced technologies. Additionally, the quality of management and the unique know-how company possesses play a significant role in attracting investment. These factors not only enhance profitability, but also ensure long-term sustainability in a competitive market. Understanding investor motivation helps businesses align their strategies to attract and retain capital. One of the most fundamental concepts in financial evaluation is net present value, or NPV. NPV calculates the current value of future cash flows by discounting them to the present using a specific rate. This method helps determine whether an investment will generate more value than its cost. A positive NPV indicates a profitable investment, while a negative NPV suggests the opposite. NPV is widely used because it considers both the time value of money and the risks associated with future cash flows. Discount rate is a crucial element in NPV calculations. It reflects both the risk of the investment and the opportunity cost of capital. A higher discount rate is used for riskier projects, reducing the present value of future cash flows. Conversely, a lower rate is applied to safer investments. By adjusting the discount rate, businesses can account for uncertainty and ensure that only projects with acceptable risk profiles are pursued. This approach helps in making more informed and balanced investment decisions. This plays a significant role in determining the net present value of an investment. As the perceived risk increases, the discount rate rises, which in turn lowers the NPV. This relationship ensures that only investments with a suitable risk-return balance are considered. By carefully estimating risk and adjusting the discount rate accordingly, companies can avoid overestimating the value of uncertain projects and focus on those that truly add value. Traditional financial performance indicators have long been used to assess a company's health. These include cash flow analysis, profit and loss statements, and balance sheets. By examining these metrics, businesses can evaluate their ability to generate cash, manage expenses, and sustain operations. While these indicators provide valuable insights, they also have limitations, especially in capturing the full picture of a company's long-term value creation. Cash flow can be calculated using direct or indirect methods. The direct method focuses on actual cash receipts and payments, making it straightforward for short-term planning. The indirect method starts with net income and adjusts for non-cash items, such as depreciation and changes in working capital. Both methods offer unique perspectives, helping businesses understand their liquidity and operational efficiency from different angles. Depreciation is a key concept in financial analysis. It represents the allocation of an asset's cost over its useful life. By accounting for depreciation, companies can more accurately reflect the wear and tear on their assets and ensure that profits are not overstated. Depreciation also impacts cash flow calculations, as it is a non-cash expense that reduces taxable income without affecting actual cash outflow. While traditional financial indicators are useful, they have notable drawbacks. For example, they may not fully capture the impact of extraordinary events or changes in accounting policies. Additionally, these indicators often struggle to reflect the true opportunity costs and risks associated with business decisions. As a result, relying solely on classical metrics can lead to an incomplete or even misleading assessment of a company's performance. Financial analysis tools help businesses evaluate their past and present performance. These tools include horizontal and vertical analysis, which compare financial data across periods and within statements. By identifying trends and structural changes, companies can make better strategic decisions. Financial analysis also provides the foundation for forecasting and scenario planning, enabling proactive management. Financial performance can be measured using both absolute and relative indicators. Absolute indicators, such as total revenue or profit, provide direct measures of business size and success. Relative indicators, like profit margins or return on assets, offer insights into efficiency and effectiveness. By combining both types, businesses gain a more comprehensive understanding of their financial health and competitive position. Horizontal analysis compares financial data over multiple periods, highlighting trends and growth rates. Vertical analysis, on the other hand, expresses each item in a financial statement as a percentage of a base figure, such as total sales or assets. These techniques help managers and investors spot patterns, assess structural changes, and make more informed decisions about the company's direction. Liquidity is a company's ability to meet short-term obligations. Working capital, calculated as current assets minus current liabilities, is a key measure of liquidity. Maintaining adequate working capital ensures that a business can cover its day-to-day expenses and avoid financial distress. Effective management of liquidity and working capital is essential for operational stability and growth. Ratio analysis is a powerful tool for evaluating a company's financial performance. Key ratios include profitability, liquidity, and solvency ratios. Profitability ratios measure how efficiently a company generates profit, while liquidity ratios assess its ability to meet short-term obligations. Solvency ratios evaluate long-term financial stability. Together, these ratios provide a detailed picture of a company's strengths and weaknesses. Profitability analysis focuses on a company's ability to generate earnings relative to its expenses and other costs. Common metrics include return on equity (ROE) and return on assets (ROA). These indicators help stakeholders assess how well a company is using its resources to create value. High profitability ratios are generally seen as a sign of effective management and strong financial health. Solvency refers to a company's ability to meet its long-term obligations. The financial structure, including the mix of debt and equity, plays a crucial role in determining solvency. A balanced financial structure ensures that a company can withstand economic downturns and continue operations. Monitoring solvency ratios helps businesses manage risk and maintain investor confidence. Interest coverage ratio measures a company's ability to pay interest on its debt. It is calculated by dividing earnings before interest and taxes (EBIT) by interest expenses. A higher ratio indicates greater financial stability and a lower risk of default. This metric is especially important for companies with significant debt, as it signals their capacity to service obligations. Debt repayment period indicates how long it will take a company to repay its debts using operational cash flow. This metric helps assess the company's financial flexibility and risk exposure. A shorter repayment period is generally preferred, as it suggests strong cash flow and lower financial risk. Monitoring this period enables better debt management and planning. Equity to debt ratios compare a company's own capital to its borrowed funds. These ratios provide insight into the company's leverage and financial risk. A higher equity ratio indicates a more conservative financial structure, while a higher debt ratio suggests greater risk but potentially higher returns. Balancing equity and debt is key to sustainable growth. Capital market indicators, such as the P/E ratio, help investors evaluate the value of a company's shares. Blue-chip stocks, known for their stability and quality, are often used as benchmarks. These indicators provide a market-based perspective on a company's performance and future prospects, complementing internal financial metrics. Return on equity, or ROE, measures a company's profitability relative to shareholders' equity. It shows how effectively a company is using its equity base to generate profits. A higher ROE is generally seen as a sign of strong management and efficient use of capital. This metric is widely used by investors to compare companies within the same industry. Return on assets, or ROA, evaluates how efficiently a company uses its assets to generate profit. It is calculated by dividing net income by total assets. A higher ROA indicates that the company is making good use of its resources. This metric is especially useful for comparing companies with different asset bases. Benchmarking involves comparing a company's performance against industry standards or competitors. This process helps identify strengths, weaknesses, and areas for improvement. By understanding their position in the market, companies can set realistic goals and adopt best practices to enhance their financial performance. Financial analysis, while powerful, has its limitations. Historical data may not always reflect current market conditions, especially during periods of inflation or economic change. Additionally, accounting policies and extraordinary events can distort results. It's important to interpret financial metrics in context and supplement them with qualitative insights. Modern financial performance metrics go beyond traditional measures. They focus on value creation, strategic investments, and operational efficiency. Metrics like economic value added (EVA) and benchmarking against best-in-class companies provide a more comprehensive view of a company's long-term potential. These approaches help businesses adapt to changing market dynamics and investor expectations. Modern evaluation methods distinguish between operational and strategic assets. Operational assets are essential for day-to-day activities, while strategic assets support long-term growth and competitive advantage. By identifying and managing both types, companies can optimize resource allocation and drive sustainable success. Economic value added, or EVA, is a modern metric that measures a company's true economic profit. It calculates the value created above the required return on capital. EVA encourages managers to focus on long-term value creation rather than short-term gains. This approach aligns management decisions with shareholder interests and sustainable growth. Both EVA and NPV are valuable tools for investment decision-making. While NPV focuses on the present value of future cash flows, EVA measures the value created each year above the cost of capital. In practice, both methods often lead to similar conclusions, but EVA provides ongoing performance feedback, making it useful for continuous improvement. Market value of a company is closely linked to its ability to generate positive EVA. Investors reward companies that consistently create value above their cost of capital. Over time, the sum of future expected EVA is reflected in the company's market valuation. This relationship highlights the importance of sustainable value creation for long-term success. REVA, or residual economic value added, is a variation of EVA that incorporates market-based capital values. This metric adjusts for market realities, providing a more accurate picture of value creation. By using REVA, companies can better align their internal performance metrics with external investor expectations. Earnings per share (EPS) and economic value added (EVA) are both used to assess company performance, but they have different focuses. EPS measures profitability on a per share basis, while EVA evaluates value creation after accounting for the cost of capital. Relying solely on EPS can encourage short-term thinking, whereas EVA promotes sustainable long-term growth. Maximizing shareholder value is a central goal for most companies. This involves not just increasing profits, but also ensuring that investments generate returns above the cost of capital. By focusing on metrics like EVA and NPV, companies can align their strategies with shareholder interests and drive sustainable value creation. In making investment decisions, it's essential to ensure that the expected return exceeds the cost of capital. Tools like NPV, EVA, and ROI help evaluate whether a project will add value. Only investments that meet these criteria should be pursued, as they contribute to the company's long-term success and financial health. Return on investment (ROI) and weighted average cost of capital (WACC) are key metrics in investment analysis. ROI measures the profitability of an investment, while WACC represents the average cost of financing. For an investment to be worthwhile, its ROI must exceed the WACC, ensuring that it creates value for the company. Market value of a business is often calculated as the sum of invested capital and the present value of future EVA. This approach links internal performance metrics with external market perceptions, providing a holistic view of a company's worth. It emphasizes the importance of both operational efficiency and strategic value creation. Forecasting and scenario planning are essential for navigating uncertainty. By projecting future financial performance under different scenarios, companies can prepare for potential risks and opportunities. This proactive approach supports better decision-making and helps ensure long-term resilience. Inflation can significantly impact financial metrics by eroding the real value of money. It's important to adjust financial analysis for inflation to ensure accurate comparisons over time. Ignoring inflation can lead to distorted results and poor decision-making, especially in long-term planning. While quantitative metrics are essential, qualitative factors such as management quality, corporate culture, and market positioning also influence financial performance. Incorporating these elements into analysis provides a more complete picture and supports better strategic decisions. Continuous improvement is vital for maintaining competitiveness. By regularly reviewing financial performance and benchmarking against best practices, companies can identify areas for enhancement and drive ongoing success. This mindset fosters innovation and adaptability in a changing business environment. Strategic investments are those that support long-term goals and competitive advantage. Evaluating these investments requires a thorough understanding of both financial and non-financial factors. By aligning investment decisions with strategic objectives, companies can ensure sustainable growth and value creation. Technology plays an increasingly important role in financial analysis and decision-making. Advanced analytics, automation, and digital tools enable more accurate forecasting, real-time monitoring, and data-driven insights. Embracing technology helps companies stay ahead in a competitive landscape. Sustainable value creation is about balancing short-term results with long-term objectives. Companies that focus on sustainability not only enhance their reputation, but also build resilience against market fluctuations. Integrating sustainability into financial analysis supports responsible growth and stakeholder trust. To summarize, effective financial performance evaluation combines traditional metrics like NPV, ROE, and liquidity ratios with modern approaches such as EVA and benchmarking. By understanding both the numbers and the context behind them, businesses can make smarter decisions and achieve lasting success. Applying these financial metrics in real-world scenarios involves regular monitoring, critical analysis, and strategic adjustments. Companies that integrate these practices into their management processes are better positioned to respond to challenges and seize new opportunities as they arise. Let's start by setting the stage. Why is value-based management so crucial in today's competitive environment? Traditional bonus models have long been used to motivate employees and managers. These systems typically rely on preset performance metrics such as operational profit or revenue targets. However, they often fail to fully align management's interests with those of shareholders. For example, bonuses may be paid even when the company's overall value doesn't increase or when risk isn't properly accounted for. This can lead to demotivation if targets are set too high or too low and may not encourage long-term value creation. One major limitation of classic bonus systems is their lack of connection to true value creation. Often these models use simple profit measures that don't account for the cost of capital or risk. As a result, managers might focus on short-term gains rather than sustainable growth. Additionally, the bonus payout zone defined by minimum and maximum thresholds can lead to employees clustering around the target, reducing motivation for exceptional performance. This structure may also ignore the broader strategic goals of the company. To address some of these issues, many companies have introduced managerial stock options. These options give managers the right to purchase company shares at a set price, aligning their interests with shareholders. However, if the market as a whole rises or falls, managers may benefit or suffer regardless of their own performance. This system can encourage risk-taking, but it may not always reward true value creation within the company. Economic value added, or EVA, is a performance metric that measures a company's true economic profit. EVA is calculated by subtracting the cost of capital from net operating profit after taxes. When used in bonus systems, EVA ensures that bonuses are only paid when the company generates returns above its capital costs. This approach directly links management rewards to value creation, encouraging decisions that benefit both the company and its shareholders. Tying bonuses to EVA, companies ensure that management's goals are closely aligned with those of shareholders. If EVA is zero, it means the company has just covered its cost of capital, no real value has been created. Only when EVA is positive do managers receive bonuses, reflecting true economic profit. This system motivates managers to focus on sustainable, long-term growth rather than short-term wins. EVA is calculated using a straightforward formula. EVA equals net operating profit after taxes, NOPAT, minus the product of the company's capital and its weighted average cost of capital, WACC. This calculation ensures that all capital costs are considered, not just explicit expenses. By focusing on EVA, companies can better evaluate the effectiveness of their investments and operational decisions. EVA-based bonus systems offer several advantages. First, they provide a clear measure of value creation, making it easier to assess management performance. Second, they encourage efficient capital allocation, as managers are motivated to invest only in projects that exceed the cost of capital. Finally, EVA-based bonuses support long-term strategic thinking, as they reward sustained improvements rather than one-off gains. Despite its strengths, EVA is not without challenges. Calculating the cost of capital can be complex, especially for companies with diverse funding sources. Additionally, EVA may not fully capture the value of intangible assets or future growth opportunities. Some activities like research and development may not immediately contribute to EVA but are vital for long-term success. Companies must balance EVA with other strategic considerations. Shareholder value added, or SVA, is another important metric for evaluating company performance. SVA measures the increase in shareholder wealth over a specific period, taking into account the cost of capital and investment returns. By focusing on SVA, companies can ensure that their strategies are truly enhancing shareholder value, not just generating accounting profits. Calculation of SVA involves comparing the company's net operating profit after taxes to the cost of capital, similar to EVA. However, SVA specifically tracks changes in shareholder value, making it a useful tool for long-term planning and investment analysis. Companies use SVA to assess whether their strategies are delivering real returns to investors, guiding both operational and financial decisions. Effective market communication is essential for conveying value to investors and stakeholders. Modern networks use digital data and infrastructure to share product information, performance metrics, and strategic updates. By maintaining transparent and episodic communication, companies build trust and ensure that market participants have access to verifiable information, supporting informed investment decisions. Strategic planning processes often incorporate EVA to allocate capital efficiently. By breaking down EVA into expected future values and current performance, companies can prioritize investments that promise the highest returns. This approach ensures that resources are directed toward projects that will maximize long-term value, supporting sustainable growth and competitive advantage. Value-based management is built on three core principles: allocating capital to the highest value investments, aligning incentives with value creation, and establishing systems that support continuous improvement. By embedding these principles throughout the organization, companies can drive performance, motivate employees, and achieve long-term success. Activity-based costing, or ABC, is a method for assigning costs to products and services based on the activities required to produce them. Unlike traditional costing methods, ABC provides a more accurate picture of resource consumption, helping managers identify inefficiencies and optimize processes. This approach supports better decision-making and cost control across the organization. ABC offers several benefits over traditional costing systems. It helps companies understand the true cost of products, services, and customers by tracing expenses to specific activities. This insight enables managers to eliminate waste, improve pricing strategies, and focus on the most profitable areas of the business. Ultimately, ABC supports more informed and strategic decision-making. Building on ABC, activity-based management, ABM, uses cost information to drive process improvements and strategic initiatives. ABM focuses on managing activities to enhance value, reduce costs, and improve customer satisfaction. By continuously analyzing and refining business processes, companies can achieve greater efficiency and competitiveness. Implementing ABC and ABM requires a detailed understanding of business processes and resource flows. Companies must identify key activities, assign costs accurately, and use this information to guide decision-making. While the process can be complex, the benefits in terms of cost control and strategic focus make it a valuable investment for many organizations. Effective capital allocation is at the heart of value-based management. Companies must evaluate investment opportunities based on their potential to generate returns above the cost of capital. By prioritizing projects with the highest expected EVA or SVA, organizations can maximize shareholder value and ensure sustainable growth. Investment decisions should be guided by a thorough analysis of expected returns, risks, and strategic fit. By using metrics like EVA and SVA, companies can assess whether potential projects will truly add value. This disciplined approach helps avoid overinvestment in low-return areas and supports the company's long-term objectives. Both operational and financial decisions impact a company's ability to create value. Operational choices, such as process improvements or product launches, affect profitability and efficiency. Financial decisions like capital structure or funding sources influence the cost of capital. By integrating EVA and SVA into decision-making, companies can ensure that all actions contribute to long-term value creation. Discounted cash flow (DCF) analysis is a fundamental tool for evaluating investment opportunities. By projecting future cash flows and discounting them to present value, companies can assess whether a project will generate returns above the cost of capital. DCF complements EVA and SVA by providing a forward-looking perspective on value creation. Measuring value is not always straightforward. Complexities arise from estimating the cost of capital, forecasting future cash flows, and accounting for intangible assets. Additionally, external factors like market volatility and regulatory changes can impact value creation. Companies must use a combination of metrics and judgment to navigate these challenges effectively. Continuous improvement is essential for sustaining value creation. By regularly reviewing EVA performance, companies can identify areas for operational enhancement and strategic adjustment. This ongoing process ensures that the organization remains agile and responsive to changing market conditions, driving long-term success. There's a strong connection between EVA and a company's share price. When EVA increases, it signals that the company is generating returns above its cost of capital, which can lead to higher market valuations. Conversely, declining EVA may result in lower share prices. By focusing on EVA, companies can directly influence shareholder wealth. Some companies use EVA bonus banking systems, where bonuses are only paid out when EVA targets are consistently met. If EVA falls below target in future periods, bonuses may be withheld or clawed back. This approach encourages long-term performance and discourages short-term risk-taking that could harm future value. When evaluating investment projects, companies must consider both operational profitability and the impact on capital costs. Metrics like EVA and SVA help ensure that only value-adding projects are approved. This disciplined approach supports efficient resource allocation and maximizes returns for shareholders. Operational policies often use specific metrics to monitor performance, such as cost ratios or productivity measures. By tracking these indicators, companies can identify areas for improvement and ensure that operations are aligned with strategic goals. These metrics support informed decision-making and continuous process optimization. Understanding the company's cost structure is vital for effective management. By analyzing fixed and variable costs, managers can identify opportunities to improve efficiency and reduce expenses. Activity-based costing provides a detailed view of cost drivers, enabling more precise control over resource allocation. In practice, ABC involves mapping out all activities involved in producing a product or service, assigning costs to each activity, and then linking those costs to products or customers. This granular approach reveals which products or services are truly profitable and which may be draining resources, guiding strategic adjustments. ABC also enables customer profitability analysis by tracing costs to individual customers or segments. This insight helps companies focus on the most valuable relationships and tailor their offerings to maximize returns. By understanding customer-level profitability, businesses can refine their marketing and service strategies. ABM takes the insights from ABC and applies them to process optimization. By continuously monitoring activity costs and outcomes, companies can streamline operations, eliminate waste, and enhance value delivery. This proactive approach supports ongoing improvement and competitive advantage. Effective management of working capital, such as receivables, payables, and inventory, is essential for maintaining liquidity and supporting growth. Companies must balance the need for operational flexibility with the goal of minimizing idle resources. By optimizing working capital, businesses can free up cash for investment and value creation. Beta is a key metric in assessing the risk of an investment relative to the market. A beta greater than 1 indicates higher volatility than the market, while a beta less than 1 suggests lower risk. By considering beta, companies and investors can make informed decisions about risk and expected returns, supporting more effective capital allocation. Market risk directly influences the cost of capital. Higher risk requires higher expected returns to attract investment. By accurately assessing and managing market risk, companies can optimize their capital structure and ensure that projects meet required return thresholds. This careful balance supports long-term value creation. Most effective organizations integrate EVA, SVA, and ABC into a comprehensive management system. By combining value-based metrics with detailed cost analysis, companies can make better decisions, align incentives, and drive continuous improvement. This integrated approach ensures that all aspects of the business are focused on creating sustainable value. Implementing value-based management systems can be challenging. It requires cultural change, investment in data systems, and ongoing training. Resistance to change and complexity in measurement can slow progress. However, with strong leadership and clear communication, companies can overcome these barriers and realize the full benefits of value-based management. Business environment is constantly evolving, and companies must adapt their value measurement and management systems accordingly. Continuous learning, feedback, and adaptation are essential for staying ahead of the competition and maintaining value creation. By fostering a culture of innovation, organizations can ensure long-term success. Let's look at a real-world example of EVA in action. A manufacturing company implemented EVA-based bonuses and saw a significant improvement in capital allocation and operational efficiency. Managers became more focused on long-term value creation, and the company's share price reflected these positive changes. This case demonstrates the power of aligning incentives with value-based metrics. From this case, we learn that successful implementation of value-based management requires clear communication, strong leadership, and a willingness to adapt. It's important to involve all stakeholders and provide the necessary training and support. By focusing on continuous improvement and learning, companies can sustain the benefits of value-based management over time. Looking ahead, value-based management will continue to evolve with advances in technology and data analytics. Companies will increasingly use real-time data to monitor performance and adjust strategies. Artificial intelligence and machine learning may further enhance decision-making, enabling even more precise value measurement and management. Environmental, social, and governance (ESG) factors are becoming increasingly important in value measurement. Companies are integrating ESG metrics into their value-based management systems to ensure sustainable and responsible growth. This holistic approach aligns financial performance with broader societal goals, supporting long-term success. Recap: we've explored the evolution from traditional bonus models to advanced value-based management systems. Metrics like EVA and SVA provide a clear link between management actions and shareholder value, while ABC and ABM support efficient resource allocation. By integrating these tools, companies can drive sustainable growth and long-term success. Value creation is the ultimate goal of any business. By adopting value-based management practices, aligning incentives, and continuously improving processes, companies can maximize returns for shareholders and stakeholders alike. The journey requires commitment, adaptability, and a focus on long-term results, but the rewards are well worth the effort. Thank you for joining us on this exploration of value-based management, EVA, SVA, and modern bonus systems. As you move forward, consider how these concepts can be applied in your own organization to drive performance and create lasting value. Stay curious, keep learning, and continue striving for excellence in everything you do. Welcome. Today, we're diving into the essential role of the financial manager within an organization. Financial managers are responsible for overseeing the financial health of a business, ensuring that resources are allocated efficiently, and that the company remains profitable and compliant with regulations. Their work touches every aspect of the organization, from budgeting and forecasting to risk management and strategic planning. Understanding their role is key to grasping how businesses make informed decisions and achieve long-term success. Let's begin by exploring the core differences between financial and managerial accounting, which form the foundation of financial management. Financial accounting and managerial accounting serve distinct purposes within an organization. Financial accounting is primarily concerned with recording past activities and calculating income tax. It's mandatory and ensures that all financial transactions are accurately documented for external reporting. On the other hand, managerial accounting focuses on collecting data to support decision-making and forecasting future trends. Unlike financial accounting, managerial accounting is not compulsory, but it's invaluable for internal management. This distinction helps organizations balance regulatory compliance with strategic planning. While managerial accounting and controlling are closely related, they are not the same. Controlling draws from both classical and managerial accounting data, but it goes further by incorporating a range of additional information, not always expressed in financial terms. The main principles of controlling include a focus on goals, future orientation, and identifying bottlenecks. Essentially, controlling is a management method aimed at achieving results by using comprehensive data to guide the company toward its objectives. Understanding financial statements is crucial for any financial manager. The income statement and balance sheet provide insights into the company's economic results. The cash flow statement and balance sheet reveal the status of cash resources. Overdue receivables are found in the notes to the financial statements, while depreciation is detailed in the cash flow statement. Provisions are shown in the balance sheet. Each report offers a unique perspective, helping managers make informed decisions about the company's financial health. It's important to distinguish between costs and expenses, as well as revenues and income. Costs refer to everything consumed in the production of goods or services, while expenses are actual cash outflows that occur when payments are made. Revenues are the amounts a company earns through its activities, whereas income represents the real cash inflows from completed transactions. Understanding these differences helps managers track financial performance more accurately and make better business decisions. Companies' assets are divided into long-term and current assets. Long-term assets or fixed assets have a lifespan longer than 1 year, are tangible, and typically have a purchase price above a certain threshold. They gradually depreciate over time. Current assets, on the other hand, are constantly changing and are organized by liquidity, with a maturity of less than 1 year. These include cash materials, work in progress, finished goods, receivables, and cash equivalent. Proper asset management ensures the company remains agile and financially stable. Long-term assets are those with a useful life exceeding 1 year, such as machinery, buildings, or vehicles. Their value is typically higher and they are subject to depreciation over time. Current assets, in contrast, are more liquid and include items like cash, inventory, and receivables. These assets are expected to be converted into cash within a year. Understanding the distinction between these asset types helps managers plan for both immediate needs and long-term investment. There are several types of financial statements that organizations prepare. The regular or statutory financial statement is prepared at the balance sheet date and closes the accounting books for that period. Extraordinary statements are created only when a company enters liquidation or bankruptcy. Interim statements are prepared during the accounting period, often in connection with changes in the company's legal form. Each type serves a specific purpose and provides stakeholders with relevant financial information. Cash flow statement is a vital tool for tracking a company's inflows and outflows of cash. It's based on actual cash receipts and payments, providing a clear picture of liquidity. There are two main methods for preparing a cash flow statement: the direct method, which calculates the difference between receipts and payments, and the indirect method, which adjusts net income for non-cash items and changes in balance sheet account. While the direct method offers more precise results, it's less commonly used due to its complexity. Concept of the time value of money is fundamental in finance. Money today is worth more than the same amount in the future due to inflation and the potential to earn interest. Inflation, managed by monetary policy and banking authorities, erodes purchasing power over time. For example, with inflation at 2.8%, the value of money decreases each year. Understanding this principle helps managers make better investment and financing decisions. Present value refers to the current worth of a sum of money, calculated as if it were received today without interest. Future value, on the other hand, is the amount that will be received in the future, including both the principal and any interest earned. These concepts are essential for evaluating investment opportunities and comparing the benefits of receiving money now versus later. High levels of debt are not always suitable for companies facing significant business risks. As debt increases, so does the risk that the company may struggle to meet interest payments, potentially leading to financial distress. Financial managers must carefully balance the benefits of leveraging debt with the risks it introduces, especially in volatile industries or uncertain economic conditions. From an investor's perspective, risky investments offer higher potential returns but come with greater uncertainty. Examples include stocks or commodities, where prices can fluctuate significantly. Risk-free investments, such as short-term government securities or bonds, provide much lower returns but are considered safer. Understanding the trade-off between risk and return is crucial for building a balanced investment portfolio. Investing in physical assets like precious metals carries unique risks. These markets are often less regulated, which can lead to significant price swings and potential losses. Financial assets such as bonds or stocks are subject to market volatility and are not insured against loss. Each type of investment requires careful analysis to understand the specific risks involved and to develop strategies for mitigating them. In deciding whether to keep cash in your wallet or deposit it in a bank account, it's generally better to use a bank account. This way, your money can earn interest even if the rate is low. In practice, the difference may be minimal, especially if the interest rate is only 0.5%. However, keeping money in a bank is usually safer and can help it grow over time, even if only slightly. Owning a portfolio of long-term government bonds is not entirely risk-free. The level of risk depends on the issuing country. These bonds are exposed to interest rate risk and inflation risk, which can erode returns over time. While short-term government bonds are generally considered less risky, it's important to remember that no investment is completely without risk. Financial risk can be measured in several ways. One approach is to assess the probability of different outcomes, though this can be influenced by personal biases. More objective methods include calculating the standard deviation and variance based on historical data, as well as using the coefficient of variation and correlation coefficient. These tools help managers and investors quantify risk and make more informed decisions. Investment returns are typically measured by profitability or return on investment. This can be calculated using either the present or future value of the invested amount. By comparing these values, managers can determine whether an investment is likely to be profitable and how it contributes to the company's overall financial goals. Inventory management cycle describes how current assets flow through a business. It starts with purchasing raw materials, which are then transformed into work in progress and finished goods. These products are sold, generating receivables, which are eventually converted back into cash. Efficient inventory management ensures that this cycle runs smoothly, minimizing costs and maximizing profitability. Main goal of inventory management is to ensure the smooth operation of business activities while keeping costs as low as possible. This requires balancing operational needs with economic considerations, such as minimizing storage costs and avoiding stockouts. By optimizing inventory levels, companies can improve efficiency and profitability. There are several types of inventory, each serving a specific purpose in the production process. Raw materials are the basic inputs, work in progress represents items being manufactured, and finished goods are ready for sale. Additionally, companies may hold maintenance, repair, and operating supplies. Understanding these categories helps managers optimize inventory levels and reduce costs. Inventory turnover measures how quickly a company sells and replaces its inventory. A high turnover rate indicates efficient inventory management and strong sales, while a low rate may signal overstocking or weak demand. Monitoring this metric helps managers identify areas for improvement and optimize their supply chain. Economic order quantity (EOQ) is a formula used to determine the optimal order size that minimizes total inventory costs. By balancing ordering and holding costs, EOQ helps companies avoid both stockouts and excess inventory. Implementing EOQ can lead to significant cost savings and improved operational efficiency. Just-in-time (JIT) inventory management aims to reduce inventory levels by receiving goods only as they are needed in the production process. This approach minimizes storage costs and reduces waste, but it requires precise coordination with suppliers. JIT can help companies become more agile and responsive to market changes. ABC analysis categorizes inventory items based on their importance. A items are the most valuable and require tight control, B items are of moderate value, and C items are the least valuable. This method helps managers prioritize their efforts and allocate resources more effectively. There are several methods for valuing inventory, including FIFO, first in, first out, LIFO, last in, first out, and weighted average cost. Each method has its advantages and impacts financial statements differently. Choosing the right method depends on the company's business model and financial goals. Inventory management directly affects a company's cash flow. Excess inventory ties up cash that could be used elsewhere, while insufficient inventory can lead to lost sales. By optimizing inventory levels, companies can improve liquidity and ensure they have the resources needed for growth. Effective inventory management contributes to profitability by reducing costs and improving sales. By minimizing excess stock and avoiding stockouts, companies can increase their margins and enhance customer satisfaction. This, in turn, supports long-term business growth. Inventory is a key component of working capital, which represents the resources available for day-to-day operations. Managing inventory efficiently helps maintain a healthy balance between current assets and liabilities, ensuring the company can meet its short-term obligations. Inventory management is closely linked to supply chain management. Coordinating with suppliers, optimizing order quantities, and monitoring lead times are all essential for maintaining the right inventory levels. A well-managed supply chain ensures that products are available when needed, reducing costs and improving customer satisfaction. Modern inventory management relies heavily on technology. Software solutions can automate tracking, forecasting, and ordering, making it easier to maintain optimal inventory levels. Technology also enables real-time monitoring, helping managers respond quickly to changes in demand or supply. Managing inventory involves identifying and mitigating risks, such as supply disruptions, demand fluctuations, and obsolescence. By diversifying suppliers, maintaining safety stock, and regularly reviewing inventory levels, companies can reduce the impact of these risks and ensure business continuity. Effective inventory management enhances customer service by ensuring products are available when customers need them. This reduces lead times, prevents stockouts, and builds customer loyalty. Satisfied customers are more likely to return and recommend the company to others. Accurate forecasting is essential for effective inventory management. By analyzing historical sales data and market trends, companies can predict future demand and adjust inventory levels accordingly. This helps prevent both overstocking and stockouts, improving efficiency and profitability. Controlling inventory costs is a major focus for financial managers. This involves negotiating better terms with suppliers, reducing waste, and optimizing storage. By keeping costs under control, companies can improve their bottom line and remain competitive in the market. Inventory management is closely tied to production planning. By aligning inventory levels with production schedules, companies can avoid delays and ensure that materials are available when needed. This coordination helps maintain smooth operations and reduces the risk of production stoppages. Many businesses experience seasonal fluctuations in demand. Effective inventory management involves anticipating these changes and adjusting stock levels accordingly. By preparing for peak periods, companies can meet customer needs without overstocking during slower times. Strong relationships with suppliers are essential for effective inventory management. By working closely with suppliers, companies can negotiate better terms, ensure timely deliveries, and respond quickly to changes in demand. Building trust and communication with suppliers leads to a more resilient supply chain. Companies must comply with various regulations related to inventory, such as accounting standards and safety requirements. Financial managers play a key role in ensuring that inventory records are accurate and that the company meets all legal obligations. Compliance helps avoid penalties and protects the company's reputation. Sustainable inventory management involves reducing waste, recycling materials, and choosing environmentally friendly suppliers. By adopting sustainable practices, companies can lower costs, improve their public image, and contribute to a healthier planet. Sustainability is becoming increasingly important for businesses of all sizes. Accurate inventory records are essential for financial reporting. Inventory values affect the balance sheet and income statement, influencing key financial ratios and performance metrics. Financial managers must ensure that inventory is properly valued and reported to provide stakeholders with reliable information. Inventory management also impacts taxation. The method used to value inventory can affect taxable income and the amount of tax owed. Financial managers must understand the tax implications of different inventory methods and ensure compliance with tax laws. Inventory management is a strategic function that supports the company's overall business goals. By aligning inventory policies with the company's strategy, managers can support growth, improve competitiveness, and respond effectively to market changes. Strategic inventory management is essential for long-term success. Innovation in inventory management can lead to significant improvements in efficiency and profitability. By adopting new technologies, processes, and best practices, companies can stay ahead of the competition and better meet customer needs. Continuous improvement is key to maintaining a competitive edge. Summary: the financial manager plays a vital role in every aspect of a company's operations, from accounting and risk management to inventory control and strategic planning. By understanding the key concepts and tools discussed in this video, you'll be better equipped to make informed decisions and contribute to your organization's success. Remember, effective financial management is the foundation of a healthy, growing business. Welcome. Today we're diving into the world of inventory management, a crucial aspect for any business dealing with goods and materials. Understanding the different types of inventory and how to manage them efficiently can make a significant difference in operational success. We'll explore the main categories of stock, essential formulas, and practical methods used in real-world inventory control. Whether you're new to the topic or looking to refresh your knowledge, this comprehensive guide will walk you through everything you need to know, starting with the basics and moving into more advanced concepts. Let's get started by defining what inventory is and why it matters. Regular inventory, sometimes called cycle stock, refers to the portion of inventory that covers needs during the period between two deliveries. This is the stock you rely on for day-to-day operations, ensuring that production or sales can continue smoothly until the next shipment arrives. Managing regular inventory effectively helps prevent shortages and keeps the supply chain running efficiently. It's important to monitor usage rates and delivery schedules closely to maintain optimal levels of regular inventory, avoiding both overstocking and stockouts. Safety inventory, or safety stock, is designed to cover unexpected fluctuations in consumption, delivery quantities, or supply chain disruptions. Its main role is to prevent interruptions in the flow of goods, especially when actual usage deviates from planned consumption. For example, if a delivery is delayed or there's a sudden spike in demand, safety inventory acts as a buffer, ensuring operations aren't halted. This type of stock is essential for risk management and maintaining customer satisfaction. Technological inventory is kept to meet specific technological requirements for preparing materials before use. This type of stock is only created for certain materials that require processing, such as drying or other modifications, before they can be used in production. By maintaining technological inventory, businesses ensure that materials are always ready for immediate use, minimizing delays and optimizing production processes. It's a specialized form of inventory tailored to unique operational needs. Maximum inventory, often denoted as ZMAX, represents the highest level of stock reached at the moment a new delivery arrives. This level includes regular, safety, and technological inventory. Setting a maximum inventory level helps businesses avoid excessive stock, which can tie up capital and increase storage costs. It also provides a clear benchmark for when to stop ordering more goods, ensuring efficient use of resources and space. Minimum inventory, or ZMIN, is the lowest stock level reached just before a new delivery. At this point, only safety inventory remains, acting as a last line of defense against stockouts. Maintaining a minimum inventory level is crucial for risk management, ensuring that even in the face of unexpected delays or demand spikes, the business can continue operating without interruption. It's a key metric in inventory planning. Average inventory is a useful measure for understanding typical stock levels over time. In situations with steady, even consumption, the average inventory equals half of the optimal delivery quantity. This metric helps businesses gauge how much stock is usually on hand, aiding in planning and cost analysis. By tracking average inventory, companies can identify trends, optimize ordering schedules, and minimize holding costs. Recap: regular inventory is the portion of stock that covers needs between two deliveries. It's the backbone of daily operations, ensuring that materials are available when needed. By carefully managing regular inventory, businesses can maintain smooth workflows and avoid unnecessary disruptions. This type of inventory is fundamental to effective supply chain management. Safety inventory plays a vital role in real-world operations. It helps businesses handle unforeseen situations, such as delivery delays or sudden increases in material usage. By maintaining a buffer of safety stock, companies can respond quickly to changes without halting production or disappointing customers. This proactive approach reduces risk and enhances reliability. Technological inventory is especially important for industries where materials require preparation before use. For example, some materials may need to be dried, treated, or otherwise modified before entering the production process. By keeping a dedicated stock for these needs, businesses can ensure that production lines run smoothly and efficiently, without waiting for materials to be ready. Determining the optimal delivery size is key to minimizing total inventory costs. The optimal size is the quantity at which the combined costs of ordering and holding inventory are at their lowest. The formula for optimal delivery size, often called COPT, takes into account the total material consumption, the cost per order, and the holding cost per unit. By applying this formula, businesses can make data-driven decisions that balance cost and efficiency. Let's break down the optimal delivery formula. COPT equals the square root of 2 times total consumption times cost per order divided by the holding cost per unit. This calculation helps determine the most economical order size, reducing both excess inventory and frequent ordering. By using this approach, companies can streamline their supply chain and improve profitability. Calculating total inventory costs involves adding together the costs of holding inventory and the costs of replenishing it. The formula is total cost equals holding cost per unit times half the order quantity, plus the cost per order times the number of orders. This comprehensive view allows businesses to see the full financial impact of their inventory decisions and identify areas for savings. Holding costs refer to the expenses associated with storing inventory, such as warehousing, insurance, and spoilage. Ordering costs, on the other hand, are the expenses incurred each time an order is placed, including administrative work and shipping. By understanding and tracking both types of costs, businesses can make smarter decisions about how much to order and when. Delivery cycles are constant but delivery quantities vary. It's helpful to visualize inventory levels on a graph. Typically, inventory decreases steadily as goods are used, then jumps up with each new delivery. This pattern helps businesses plan for fluctuations and optimize their ordering schedules, ensuring they always have the right amount of stock on hand. Total financial effect, or CFE, represents the discount or rebate a buyer receives for ordering larger quantities of inventory. The formula for CFE is total cost minus the product of total consumption, rebate rate, and unit price. This calculation helps businesses evaluate the benefits of bulk purchasing and negotiate better deals with suppliers. To apply the CFE formula, subtract the value of the rebate total consumption times rebate rate times unit price from the total inventory cost. This gives you the net financial benefit of ordering in larger quantities. By understanding this effect, businesses can make informed decisions about when and how much to order, maximizing their savings. ABC method is a popular inventory classification technique based on the 80-20 rule. 80% of outcomes come from 20% of causes. In inventory management, this means dividing stock into 3 categories based on importance or value. Category A includes the most valuable items, while B and C represent less critical stock. This approach helps businesses focus resources on the most impactful inventory. Using the ABC method, businesses can prioritize their efforts and investments. For example, they might apply stricter controls and more frequent reviews to Category A items, while using simpler processes for B and C items. This targeted approach improves efficiency and ensures that the most important inventory receives the attention it deserves. Just-in-time, JIT method aims to minimize storage costs by receiving goods only as they are needed. Deliveries are scheduled to arrive exactly when required, reducing the need for large inventories. This approach relies on strong supplier relationships and precise planning, but it can significantly lower costs and increase flexibility. In practice, just-in-time requires suppliers to deliver the right quantity, quality, and timing for each order. This method reduces the risk of overstocking and frees up capital for other uses. However, it also demands reliable logistics and quick response to changes in demand. When implemented well, JIT can streamline operations and boost competitiveness. Consignment warehouses are physical storage facilities set up by suppliers at the customer's location. The supplier maintains ownership of the stock until it's used or sold, reducing the buyer's financial burden. This arrangement allows customers to access inventory as needed without tying up their own capital, while suppliers can better manage stock levels and respond to demand. Main advantage of consignment warehouses is flexibility. Buyers can use inventory as needed without upfront costs, while suppliers retain control over their goods. This setup fosters stronger partnerships and can lead to more efficient supply chains, especially in industries with fluctuating demand or specialized products. Inventory turnover time, also known as the delivery cycle, measures how long it takes for inventory to be sold or used. The formula is simple: divide 360 by the number of inventory turnovers. This metric helps businesses understand how quickly they're moving stock and can highlight opportunities to improve efficiency. To calculate the number of inventory turnovers, divide total material consumption by the average inventory level. This figure shows how many times inventory is replaced during a given period. A higher turnover rate indicates efficient inventory management, while a lower rate may signal overstocking or slow sales. Imagine a company that consumes 1,000 units of material per year and maintains an average inventory of 200 units. The inventory turnover rate would be 1,000 divided by 200, or 5. This means the company replaces its inventory 5 times a year, providing insight into how quickly goods are moving through the system. Monitoring inventory turnover helps businesses identify trends and make informed decisions. A high turnover rate suggests strong sales or efficient use of materials, while a low rate may indicate excess stock or slow-moving items. By tracking this metric, companies can adjust their purchasing and sales strategies for better results. Money serves several key functions in the economy. First, it acts as a medium of exchange, allowing people to trade goods and services easily. Second, it's a unit of account providing a common measure for valuing products, labor, and assets. Third, money is a store of value, enabling individuals and businesses to save and preserve purchasing power over time. As a medium of exchange, money simplifies transactions by eliminating the need for barter. Whether in the form of cash, coins, or bank deposits, money allows buyers and sellers to complete deals quickly and efficiently. This function is fundamental to the smooth operation of markets and the broader economy. Money also serves as a unit of account, providing a standard way to measure and compare the value of goods, services, and assets. This makes it easier for businesses and consumers to make informed decisions, set prices, and track financial performance. Without a common unit of account, economic activity would be much more complicated. As a store of value, money allows individuals and businesses to save wealth for future use. When the currency is stable, money preserves purchasing power over time, making it a reliable way to accumulate and transfer wealth. This function is essential for long-term planning and investment. Value of money can decrease over time due to inflation, which erodes purchasing power. Inflation occurs when the general price level of goods and services rises, meaning each unit of currency buys less than before. Factors like increased money supply, rising production costs, or higher demand can all contribute to inflation. Financial assets include a range of items that represent value and can be converted into cash. These assets are essential for managing liquidity and supporting business operations. Let's look at the main components of financial assets and their characteristics. Cash is the most liquid financial asset, available in both physical forms like banknotes and coins and virtual forms such as bank account balances. Having cash on hand allows businesses to meet immediate expenses and take advantage of opportunities as they arise. Valuables or vouchers include items like stamps, meal tickets, and highway stickers. These are not cash but can be used for specific transactions or as proof of payment. Businesses often hold such items to facilitate operations and manage minor expenses. Short-term securities such as deposit certificates, promissory notes, and treasury bills are financial instruments that can be quickly converted into cash. They offer a balance between liquidity and earning potential, making them a popular choice for managing surplus funds. Solvency is a company's ability to meet its long-term financial obligations. A solvent business has enough assets to cover its debts, ensuring stability and credibility in the eyes of investors and creditors. Maintaining solvency is crucial for long-term success and growth. Liquidity refers to how quickly and easily an asset can be converted into cash without significant loss of value. High liquidity means assets can be accessed or sold rapidly, which is vital for covering short-term obligations and taking advantage of new opportunities. While both liquidity and solvency relate to a company's financial health, they focus on different timeframes. Liquidity is about meeting short-term obligations while solvency concerns long-term stability. A business can be liquid but not solvent or solvent but not liquid, so it's important to manage both aspects carefully. Different assets have varying degrees of liquidity. Cash is the most liquid, followed by short-term securities and receivables. Physical assets like equipment or real estate are less liquid, as they take longer to sell and may lose value in the process. Understanding asset liquidity helps businesses plan for cash flow needs. Effective liquidity management ensures that a business can meet its short-term obligations and seize opportunities as they arise. This involves monitoring cash balances, forecasting needs, and maintaining access to credit or liquid assets. Good liquidity management supports stability and growth. Liquidity ratios, such as the current ratio and quick ratio, are tools used to assess a company's ability to pay short-term debts. These ratios compare liquid assets to current liabilities, providing insight into financial health and risk. Regularly reviewing liquidity ratios helps businesses stay prepared for unexpected expenses. To improve liquidity, businesses can speed up receivables, delay payables, or convert non-essential assets into cash. Maintaining a cash reserve and securing lines of credit are also effective strategies. By focusing on liquidity, companies can better weather financial challenges and capitalize on new opportunities. It's important to balance liquidity and profitability. While holding more liquid assets increases security, it may reduce returns compared to investing in higher-yield opportunities. Businesses must find the right mix to ensure both financial stability and growth potential. Summary: effective inventory and financial management are essential for business success. By understanding different types of inventory, applying key formulas, and managing financial assets wisely, companies can optimize operations, reduce costs, and improve resilience. Remember to monitor both liquidity and solvency, use proven methods like ABC and JIT, and always plan for the unexpected. With these tools and insights, you're well equipped to manage inventory and finances in any business environment. Welcome. Today we're diving into the world of business finance, focusing on solvency, liquidity, and receivables management. Let's start with solvency. Solvency is a company's ability to meet all its due obligations in full at the right time and place. It's a fundamental measure of financial health, showing whether a business can pay its debts as they come due. Without solvency, even profitable companies can face serious trouble. Throughout this video, we'll explore how solvency connects with liquidity and why both are crucial for sustainable business operations. Let's move on to liquidity and see how it differs from solvency. Now let's talk about liquidity. Liquidity is a company's ability to convert its assets into cash quickly in order to cover its obligations as they become due. It's not just about having cash on hand, but also about how easily other assets can be turned into cash. Effective liquidity management aims to minimize short-term financing costs, maximize returns from financial assets, and ensure timely payment of liabilities. By maintaining strong liquidity, businesses can avoid unnecessary borrowing and reduce financial stress. Next, we'll look at the concept of liquidity in more detail and see how it's measured. Liquidity isn't just a single number, it's a spectrum. The term liquidity describes how easily different types of assets can be transformed into cash. Some assets, like inventory, take longer to sell and convert, while others, like marketable securities, can be liquidated almost instantly. The easier it is to convert an asset into cash, the higher its liquidity. This general characteristic helps businesses assess which assets are best suited for covering short-term obligations. Up next, we'll explore the main types of liquidity ratios used in business analysis. Measure liquidity. Companies use several key ratios. These ratios help managers and analysts understand how well a business can meet its short-term debts. The three most common are current or basic liquidity, quick liquidity, and immediate liquidity. Each ratio offers a different perspective on a company's ability to pay its obligations, depending on which assets are considered liquid. Let's break down each type and see how they're calculated and interpreted. Current liquidity, also known as the current ratio, measures a company's ability to pay its short-term liabilities with all its current assets. It's calculated by dividing current assets by short-term liabilities due within a year. This ratio is widely used because it's simple and gives a broad view of payment capacity. An acceptable value typically ranges from 1.6 to 2.5. The higher the ratio, the lower the risk of insolvency. However, too high a ratio might indicate inefficient use of resources. Next, let's look at quick liquidity for a more precise view. Quick liquidity, or the quick ratio, refines the current ratio by excluding the least liquid assets, such as raw materials and inventory. It's calculated as current assets minus inventory divided by short-term liabilities. This ratio gives a more accurate picture of a company's ability to meet short-term obligations without relying on selling inventory. It's especially useful in industries where inventory turnover is slow. By focusing on the most liquid assets, the quick ratio helps businesses assess their immediate financial resilience. Let's move on to the strictest measure, immediate liquidity. Immediate liquidity, or the cash ratio, is the strictest test of a company's short-term financial health. It measures the ability to pay off short-term liabilities using only cash and cash equivalents, such as funds and bank accounts. The formula is cash and equivalents divided by short-term liabilities. This ratio is rarely used by external analysts, as it requires up-to-the-minute information about cash balances. However, it's invaluable for internal management, especially during times of financial uncertainty. Next, we'll discuss methods companies use to determine the optimal amount of cash to keep on hand. Managing cash effectively is crucial for any business. Companies use several methods to determine how much cash they need. These include tracking expected cash inflows and outflows, using payment calendars to monitor due dates, calculating end-of-period cash balances, and preparing short-term financial plans. By forecasting and comparing cash receipts and payments, businesses can avoid shortages and minimize financing costs. Monitoring cash flow is an ongoing process that helps ensure obligations are met on time. Next, let's look at specific models used for cash management. One practical tool for cash management is the payment calendar. This is a short-term overview of all payables and receivables, helping businesses anticipate when cash will be needed or available. By regularly updating the payment calendar, companies can plan for upcoming obligations and avoid last-minute surprises. Alongside this, calculating the expected cash balance at the end of each period provides a clear picture of liquidity. These methods form the foundation for more advanced financial planning, which we'll discuss next. Short-term financial plans are essential for managing liquidity. These plans are based on monitoring, estimating, and comparing expected cash inflows and outflows. By projecting future cash movements, businesses can identify potential gaps and take action in advance. This proactive approach helps minimize the need for expensive short-term borrowing and ensures that funds are available when needed. Let's now explore how monitoring cash flow, or cash flow analysis, supports these efforts. Cash flow monitoring is a continuous process of tracking all cash receipts and payments. By keeping a close eye on cash flow, businesses can quickly spot trends, anticipate shortages, and make informed decisions. This process is vital for maintaining liquidity and avoiding costly disruptions. Regular cash flow analysis also supports strategic planning, helping companies align their financial resources with business goals. Next, we'll introduce two widely used models for managing cash, the Baumol and Miller-Rohr models. To optimize cash holdings, companies often use mathematical models. The two most popular are the Baumol model and the Miller-Rohr model. These models help businesses determine the optimal amount of cash to keep on hand, balancing the costs of holding cash against the costs of obtaining it. Each model takes a different approach, reflecting the realities of cash flow in business. Let's take a closer look at the Baumol model first. The Baumol model treats cash like inventory. It assumes that cash is used steadily over time, and when it runs low, the company replenishes it in fixed amounts. The goal is to minimize the total cost of acquiring and holding cash. The optimal cash balance is found by balancing transaction costs with the opportunity cost of holding cash. This model works best when cash outflows are predictable. Next, we'll see how the Miller-Rohr model offers a more flexible approach. Miller-Rohr model is more realistic for most businesses. It recognizes that cash flows are unpredictable and can fluctuate daily. Instead of fixed replenishments, this model sets upper and lower limits for cash balances. When the cash balance hits the upper limit, excess cash is invested. When it hits the lower limit, cash is replenished. The model helps companies manage cash more flexibly, adapting to real-world uncertainties. Let's now look at how to calculate the optimal cash balance using these models. Find the optimal cash balance. Companies use a formula that weighs the costs of obtaining cash against the costs of holding it. The goal is to minimize total costs. In the Baumol model, the formula for optimal cash acquisition is based on transaction costs, the amount needed, and the opportunity cost of holding cash. In the Miller-Rohr model, the upper limit and return point are set according to transaction costs and the variance of daily cash balances. This scientific approach helps businesses stay liquid without tying up too much capital. The Miller-Rohr model, setting the upper limit and return point, is crucial. These limits depend on transaction costs and the variability of daily cash balances. The higher the transaction costs or the greater the fluctuations in cash, the wider the limits need to be. By adjusting these parameters, companies can tailor their cash management strategy to their unique needs. This flexibility is a key advantage of the Miller-Rohr model. Next, let's discuss why it's better to invest surplus cash rather than leave it idle. Leaving surplus cash in a bank account isn't always wise. Due to inflation, the value of money decreases over time. That's why it's often better to invest excess funds in liquid assets, such as securities, which offer a certain return and can be quickly converted back to cash if needed. This approach helps businesses preserve the value of their money and even earn additional income. Let's now shift our focus to receivables management, another key aspect of financial health. Managing receivables is about more than just collecting payments. The main goal is to protect the company from a high proportion of overdue invoices and to minimize uncollectible receivables. A good receivables management system tracks business transactions even before products are delivered or invoices are issued. This proactive approach helps companies maintain healthy cash flow and reduce financial risks. Next, we'll explore the different ways receivables can be secured. There are several methods companies use to secure their receivables. These include insurance, advance payments, pledges on specific assets, guarantees by owners or third parties, bank guarantees, documentary credits, documentary collections, forfeiting, and factoring. Each method offers different levels of protection against non-payment. By choosing the right mix, businesses can reduce the risk of bad debts and improve their financial stability. Let's look at the pros and cons of extending credit to customers. Offering credit to customers can boost sales and provide a competitive advantage. It allows buyers to finance their purchases in the short term, making your products more attractive. This can lead to higher sales volumes and stronger customer relationships. However, extending credit also comes with risks, which we'll discuss in the next scene. Main downside of receivables is the risk that customers won't pay their invoices. This can lead to cash flow problems and increase the company's financing costs, as it may need to borrow to cover its own obligations. Managing this risk is a key part of receivables management. By carefully screening customers and using appropriate security measures, companies can minimize the negative impact. Next, let's explain what factoring is and how it works. Factoring is a financial service where a company sells its short-term receivables, usually those due within 180 days, to a factoring organization, often a bank. The factoring company buys the invoice and assumes the risk that the customer won't pay. This provides immediate cash to the seller and shifts the risk of non-payment to the factor. Factoring is especially useful for businesses that need quick access to funds or want to reduce their exposure to bad debt. Next, we'll compare documentary credits and collections. Documentary credit offers the highest level of security in trade transactions. It ensures that payment will be made as long as the seller meets the terms of the credit. In contrast, documentary collection is a payment method where documents are released to the buyer only upon payment. While both methods help manage payment risks, documentary credit provides stronger protection for sellers. Let's now discuss outsourcing receivables management. Outsourcing receivables management means delegating certain business activities to an external provider. This allows the company to focus on its core operations while benefiting from the expertise of specialists. Outsourcing can lead to more accurate planning, increased flexibility, lower costs, faster processes, and higher production volumes. Ultimately, this can boost profitability and efficiency. Next, let's summarize the key points we've covered so far. We've covered a lot of ground today. From understanding solvency and liquidity to exploring cash management models and receivable strategies, each concept plays a vital role in business finance. Effective management of liquidity and receivables helps companies stay financially healthy, avoid unnecessary risks, and seize new opportunities. In the next scenes, we'll dive deeper into practical examples and applications of these principles. Let's look at a practical example of liquidity ratios in action. Imagine a company with $500,000 in current assets and $200,000 in short-term liabilities. Its current ratio would be 2.5, indicating strong liquidity. If inventory makes up $100,000 of those assets, the quick ratio would be $500,000, $100,000 / $200,000 equals 2. This shows the company can meet its obligations even without selling inventory. Such calculations help managers make informed decisions about cash flow and risk. Suppose a business expects regular cash outflows and wants to minimize transaction costs. Using the Baumol model, it calculates the optimal cash replenishment size to balance costs. If transaction costs are high, fewer larger withdrawals are optimal. If cash flow is unpredictable, the Miller-Rohr model helps set flexible limits, ensuring the company never runs out of cash or holds too much idle money. These models turn theory into actionable strategy. Imagine a company sells goods on credit, creating receivables. To reduce risk, it insures some receivables and uses factoring for others. This way, it gets immediate cash and shifts the risk of non-payment to the factor. For high-value transactions, it uses documentary credits to guarantee payment. By combining these tools, the company maintains steady cash flow and protects itself from bad debts. Regular monitoring of receivables is essential. By tracking outstanding invoices and following up promptly, companies can reduce overdue payments and improve cash flow. Automated systems can help flag late accounts and send reminders, making the process more efficient. Effective monitoring also provides valuable data for future credit decisions, helping businesses refine their policies and minimize risk. Developing a clear credit policy is key to managing receivables. This policy should define who qualifies for credit, how much can be extended, and the terms of repayment. By setting clear guidelines, companies can reduce disputes and ensure consistent decision-making. Regularly reviewing and updating the policy helps adapt to changing market conditions and customer needs. Assessing customer creditworthiness is a crucial step before extending credit. This involves analyzing financial statements, payment history, and credit ratings. By evaluating these factors, businesses can identify reliable customers and avoid those with a history of late payments or defaults. A thorough assessment reduces the risk of bad debts and supports healthy business growth. Effective collections process is vital for timely payments. This process includes sending invoices promptly, following up on overdue accounts, and using reminders or collection agencies if necessary. Clear communication and consistent follow-up encourage customers to pay on time. By streamlining collections, companies can maintain steady cash flow and reduce the risk of uncollectible receivables. Despite best efforts, some receivables may become uncollectible. Companies need a clear process for writing off bad debts and adjusting their financial statements. This includes documenting collection attempts and complying with accounting standards. By recognizing bad debts promptly, businesses can maintain accurate records and make better financial decisions going forward. Receivables turnover measures how quickly a company collects its outstanding invoices. A higher turnover rate means faster collections and better cash flow. To improve turnover, businesses can offer discounts for early payment, tighten credit terms, or focus on high-quality customers. Monitoring this metric helps identify areas for improvement and supports overall financial health. Modern technology plays a big role in managing receivables. Automated invoicing, payment tracking, and analytics tools make it easier to monitor accounts and identify issues early. These systems can also integrate with other business software, providing a complete view of financial health. Embracing technology helps companies streamline processes and reduce manual errors. Investing in training for finance teams ensures they have the skills needed to manage liquidity and receivables effectively. Training can cover best practices in credit assessment, collections, and the use of financial software. Well-trained staff are better equipped to spot risks, implement policies, and adapt to changes in the business environment. Strong internal controls help prevent errors and fraud in receivables management. These controls include segregation of duties, regular reconciliations, and approval processes for credit and write-offs. By implementing robust controls, companies can safeguard their assets and ensure accurate financial reporting. Understanding the legal aspects of receivables is important for protecting the company's interests. This includes knowledge of contract law, debt collection regulations, and the rights of creditors. By staying informed about legal requirements, businesses can avoid disputes and enforce their claims more effectively. Managing receivables in international trade adds complexity. Companies must consider currency risks, different legal systems, and cultural differences in payment practices. Using tools like documentary credits and international factoring can help mitigate these risks and ensure timely payments from overseas customers. Economic conditions can greatly affect liquidity and receivables. During downturns, customers may delay payments, increasing the risk of bad debts. Companies need to monitor economic trends and adjust their credit policies accordingly. Staying flexible and proactive helps businesses weather economic challenges and maintain financial stability. Regular audits play a key role in ensuring the accuracy of liquidity and receivables management. Audits help identify weaknesses in processes, verify compliance with policies, and provide recommendations for improvement. By conducting regular reviews, companies can strengthen their financial controls and reduce the risk of errors or fraud. Continuous improvement is essential for effective liquidity and receivables management. By regularly reviewing processes, adopting new technologies, and learning from past experiences, companies can enhance their financial performance. Encouraging a culture of improvement ensures that the business stays competitive and resilient. To wrap up, remember that managing liquidity and receivables is about balancing risk and opportunity. By understanding key concepts, using proven models, and implementing best practices, businesses can maintain financial health and support growth. Stay proactive, keep learning, and adapt to changing conditions for long-term success. Thank you for joining us on this journey through liquidity, solvency, and receivables management. These financial fundamentals are the backbone of every successful business. By mastering them, you'll be better prepared to navigate challenges and seize new opportunities. Stay tuned for more insights and practical tips in our upcoming videos. This concludes our comprehensive guide to mastering liquidity, solvency, and receivables. We hope you found the information valuable and applicable to your business or studies. Remember, strong financial management is key to long-term success. Until next time, keep striving for financial excellence. Welcome. Today, we're diving into the world of receivables management and investment decisions. We'll explore how companies handle overdue invoices, prevent non-payment, and use factoring. Plus, we'll break down key financial concepts like Skonto, turnover ratios, and both static and dynamic investment evaluation methods. By the end, you'll have a clear understanding of how businesses manage their cash flow and make smart investment choices. Let's start by understanding why receivables are so crucial for a company's financial health. Receivables represent the money owed to a company by its customers for goods or services delivered but not yet paid for. Managing these receivables efficiently is vital, as it directly impacts a company's liquidity and ability to fund operations. If receivables are not collected on time, it can lead to cash flow problems, making it harder for the business to meet its own obligations. That's why companies implement strategies to ensure timely payments and minimize the risk of bad debt. If invoices go unpaid past their due date, companies must act quickly. The first step is usually a reminder. This can be done personally by phone, email, or mail. If the customer still doesn't respond, the company may escalate the matter, possibly involving legal action or handing the debt over to a court. In cases where the debtor is insolvent and unable to pay, the company may have to write off the receivable as a loss. These steps are essential to protect the company's financial interest. Prevention is always better than cure. To avoid non-payment, companies often assess the creditworthiness of their customers before extending credit. They may also set clear payment terms, offer incentives for early payment, and maintain regular communication with clients. These proactive measures help reduce the risk of overdue receivables and ensure a healthier cash flow for the business. Factoring is a financial tool companies use to improve cash flow. Here, how it works: a business sells its receivables to a factoring company at a discount. In return, the business gets immediate cash while the factoring company takes on the responsibility of collecting the debt. This helps companies avoid cash shortages and focus on their core operations even if some customers pay late. Skonto is a discount offered by suppliers to encourage buyers to pay their invoices early. For example, a supplier might offer a 2% discount if the invoice is paid within 10 days instead of the usual 30. This motivates customers to pay faster, improving the supplier's cash flow. However, the decision to offer or accept Skonto depends on the cost of financing. If the interest saved by paying early outweighs the discount, it's a good deal. To calculate Skonto, you need to know the sales price, the Skonto rate as a decimal, the interest rate of alternative financing, and the financing period. The absolute value of Skonto is simply the discount amount. To compare, you calculate the relative interest cost of a potential loan using the formula: sales price Skonto times interest rate times time. This helps companies decide if offering or accepting Skonto is financially beneficial. Turnover indicators help companies measure how efficiently they manage their assets. The turnover speed of receivables shows how many times receivables are collected during a period. It's calculated as 360 days divided by the average collection period. A higher turnover means faster collection and better liquidity, while a lower turnover may signal collection issues. Collection period, or days sales outstanding, tells you how long on average it takes to collect receivables. It's calculated by dividing the average receivables by daily sales. A shorter collection period means the company gets its money faster, which is good for cash flow. Monitoring this metric helps businesses spot problems early and take corrective action if needed. If a customer doesn't pay on time, the company first sends reminders. These can be personal, by phone, email, or mail. If there's still no response, the company may take legal action or pass the case to a court. If the debtor is insolvent and unable to pay, the company writes off the receivable as a loss. Each step is designed to maximize the chances of recovery while minimizing losses. Now let's shift gears and talk about investments. In business, investments can be financial, tangible, or intangible. Financial investments include things like long-term loans or buying securities. Tangible investments involve purchasing land, equipment, or buildings. Intangible investments cover things like software, licenses, or intellectual property. Each type plays a unique role in a company's growth and strategy. From an economic perspective, investments are resources allocated with the expectation of generating future returns. From an accounting viewpoint, investments are recorded as assets on the balance sheet, whether they're financial, tangible, or intangible. Understanding both perspectives helps companies make informed decisions about where to allocate their resources for the best long-term results. Let's break down the three main types of investments. Financial investments include long-term loans, securities, and deposits in investment companies. Tangible investments involve acquiring physical assets like land, machinery, or buildings. Intangible investments cover non-physical assets such as software, licenses, or intellectual property rights. Each type supports different business goals and requires different evaluation methods. Investment process typically has three phases. First is the pre-investment phase, where potential projects are identified and feasibility studies are conducted. Next comes the investment phase, when the chosen project is implemented. Finally, there's the operational phase, which covers the ongoing management and operation of the investment. Each phase is critical to ensuring the investment delivers the expected benefits. When evaluating investments, companies must consider time and risk. Static methods ignore these factors, while dynamic methods take them into account. Other important criteria include cost savings, reported profit, and cash flow from the investment. By weighing these factors, businesses can choose projects that align with their goals and risk tolerance. Investments can be classified in several ways. From an accounting perspective, they're financial investments. Based on their impact on business growth, they can be developmental. Projects can also be mutually exclusive or follow different cash flow patterns. Some investments are aimed at acquiring or reproducing tangible assets, while others are defined by their duration or organizational structure. This classification helps companies choose the right evaluation method. Funding for investments can come from various sources. Financial investments might involve buying securities or taking out long-term loans. Tangible investments expand production capacity, like building new facilities or buying equipment. Intangible investments include purchasing know-how, licenses, or copyrights. Choosing the right funding source is crucial for the success and sustainability of the project. Static methods are simple tools for evaluating investments. Their main weakness is that they don't distinguish between money received now and money received in the future. Because of this, they're best used for small projects with minimal risk. Despite their limitations, static methods can provide quick, useful insights for less significant investment decisions. There are several static methods for evaluating investments. These include average annual return, average payback period, average percentage yield, and simple payback period. Each method uses different criteria such as cost savings, profit, or cash flow to assess the attractiveness of a project. Understanding these methods helps companies make informed decisions, especially for low-risk investment. Average payback period tells you how long it takes, on average, to recover your initial investment based on expected cash flows. The simple payback period, on the other hand, is the number of years needed for cumulative cash flows to equal the initial investment. Both methods are easy to use but don't account for the time value of money, which can be a drawback for larger or riskier projects. Let's look at a practical example. Imagine a company considering a new machine that costs $10,000. The expected annual cash inflow is $2,500. Using the simple payback period, it would take 4 years to recover the investment. If the company's risk tolerance is low and the project is not critical, static evaluation methods like this can be very useful for decision-making. Dynamic methods take into account the time value of money and risk, making them more suitable for significant or long-term investments. These methods include net present value, internal rate of return, and discounted payback period. By considering when cash flows occur, dynamic methods provide a more accurate picture of an investment's true value. From an economic standpoint, investments are about allocating resources to generate future income or benefits. In accounting, investments are recorded as assets, whether they're financial, tangible, or intangible. The distinction is important because it affects how companies plan, evaluate, and report their investment activities. Discounting is a key concept in dynamic investment evaluation. It means adjusting future cash flows to their present value, reflecting the idea that money today is worth more than the same amount in the future. By discounting, companies can compare investments with different cash flow timings and make better decisions about where to allocate their resources. Main purpose of discounting is to account for the time value of money. By bringing future cash flows to their present value, companies can accurately assess the profitability of an investment. This is especially important for long-term projects, where the timing of cash flows can significantly impact the investment's value. Net present value, or NPV, is a dynamic method that calculates the present value of all future cash flows from an investment, minus the initial investment cost. If the NPV is positive, the investment is expected to generate more value than it costs, making it a good choice. NPV is widely used because it provides a clear measure of an investment's profitability. Internal rate of return, or IRR, is another dynamic method. It's the discount rate that makes the NPV of an investment zero. In other words, it's the expected annual return from the project. If the IRR is higher than the company's required rate of return, the investment is considered attractive. IRR is especially useful for comparing projects with different cash flow patterns. Discounted payback period is a variation of the simple payback period. It calculates how long it takes for the present value of cash flows to cover the initial investment. This method combines the simplicity of payback analysis with the accuracy of discounting, making it a practical tool for evaluating projects with moderate complexity. Static methods are quick and easy but ignore the time value of money and risk. Dynamic methods are more complex but provide a more accurate assessment by considering when cash flows occur and the associated risks. For small, low-risk projects, static methods may suffice. For larger or riskier investments, dynamic methods are essential. Selecting the right evaluation method depends on the project's size, complexity, and risk. For minor investments with predictable cash flows, static methods are often sufficient. For major projects with uncertain outcomes, dynamic methods provide a more reliable basis for decision-making. Companies should match the method to the project's characteristics for the best results. Imagine a company evaluating two projects. Project A requires a $20,000 investment and generates $5,000 annually for 5 years. Project B needs $15,000 and brings in $4,000 annually for 4 years. Using static methods both seem attractive, but when you apply dynamic methods, you see the impact of timing and risk, helping the company choose the better option. Modeling cash flows is essential for accurate investment evaluation. Companies estimate future inflows and outflows, considering factors like sales, costs, and market trends. These projections form the basis for both static and dynamic analyses, ensuring decisions are grounded in realistic expectations. Every investment carries some level of risk and uncertainty. Factors like market changes, economic conditions, and operational challenges can affect outcomes. Dynamic methods help companies account for these uncertainties by adjusting cash flows and discount rates, leading to more informed decisions. Before committing to an investment, companies conduct feasibility studies. These studies assess the technical, financial, and market viability of a project. By identifying potential obstacles early, businesses can avoid costly mistakes and focus on projects with the highest chances of success. Once an investment is made, the operational phase begins. This involves managing the asset, monitoring performance, and making adjustments as needed. Effective management during this phase ensures the investment delivers the expected returns and supports the company's long-term goals. Sometimes, companies must choose between projects that cannot be pursued simultaneously. These are called mutually exclusive projects. Evaluating these options requires careful analysis of expected returns, risks, and strategic fit. The goal is to select the project that offers the greatest overall benefit. Developmental investments are aimed at expanding or improving a company's operations. These projects often involve higher risk but can lead to significant growth. Evaluating developmental investments requires a thorough understanding of market trends, competitive dynamics, and the company's strategic objectives. Different projects have different cash flow patterns. Some require large upfront investments followed by steady returns, while others may have irregular inflows and outflows. Understanding these patterns is crucial for choosing the right evaluation method and managing financial risks effectively. Duration and organizational structure of a project can influence its evaluation. Projects with a defined lifespan or those set up as separate entities may require different approaches compared to ongoing investments. Tailoring the evaluation method to the project's structure ensures more accurate and relevant results. Intangible investments like software or intellectual property can be harder to evaluate than tangible assets. Their value often depends on future market trends and technological developments. Companies must use a combination of quantitative and qualitative methods to assess these investments accurately. Management plays a critical role in investment decisions. They set the company's strategic direction, allocate resources, and oversee the evaluation process. Strong leadership ensures that investments align with the company's goals and deliver the desired outcomes. After an investment is made, continuous monitoring is essential. Companies track performance, compare actual results to projections, and make adjustments as needed. This proactive approach helps maximize returns and minimize losses, ensuring long-term success. Every investment provides valuable lessons, whether it succeeds or fails. Companies analyze outcomes to identify what worked and what didn't, using these insights to improve future decision-making. This learning process is key to building a resilient and successful business. Let's recap what we've covered. We explored receivables management, including collection strategies and prevention of non-payment. We discussed Skonto, turnover ratios, and the differences between static and dynamic investment evaluation methods. Understanding these concepts helps companies manage cash flow, make better investment decisions, and achieve long-term success. Conclusion: effective receivables management and investment evaluation are essential for any business. By applying the right strategies and methods, companies can improve cash flow, minimize risks, and maximize returns. Whether you're dealing with overdue invoices or evaluating a major investment, understanding these principles will help you make smarter, more confident decisions. Welcome. Today we're diving into the world of investment evaluation, starting with the concept of discounting. Discounting is all about transforming future payments into their present value, taking into account both time and risk. Imagine you're promised a payment in the future. Would you value it the same as cash in hand today? Probably not. That's where discounting comes in. By applying a discount rate, we factor in the uncertainty and the opportunity cost of waiting. This foundational concept is crucial for making smart investment decisions, as it helps us compare different projects on a level playing field. Let's explore how this works in practice. Investments can be grouped into three main categories: long-term intangible assets, long-term tangible assets, and long-term financial assets. Intangible assets include things like software, goodwill, and valuable rights. These aren't physical, but they add value to a business. Tangible assets are the physical items: land, buildings, and equipment. Finally, financial assets cover shares in controlled companies and other long-term securities. Understanding these groups helps investors and managers allocate resources wisely, ensuring that each investment aligns with the company's strategy and risk profile. Each group has its own characteristics and risks, which we'll discuss further. Dynamic methods are essential for evaluating investment effectiveness. The core principle is to convert all future cash flows generated by an investment into present value using discounting. This approach considers both the time separation between future payments and the decision moment, as well as the risk associated with uncertain future cash flows. Key dynamic methods include net present value (NPV), internal rate of return (IRR), profitability index, and payback period. These methods provide a comprehensive view of an investment's potential, helping decision-makers weigh the benefits and risks before committing resources. Net present value (NPV) method is one of the most widely used tools in investment analysis. It involves comparing the costs of an investment with the present value of expected returns, factoring in the time value of money. By discounting future cash flows back to today, NPV provides a clear measure of whether a project will add value to the company. If the sum of discounted cash flows exceeds the initial investment, the NPV is positive, signaling a potentially profitable venture. This method is especially useful for projects with long lifespans as it captures the full financial impact over time. Let's break down the NPV formula. The calculation involves the initial investment, C0, the net cash flows in each year, CFI, the discount rate, R, and the project's lifespan, N. The formula sums the present values of all future cash flows and subtracts the initial investment. This approach ensures that every dollar earned in the future is appropriately adjusted for risk and time. By using this formula, investors can objectively assess whether a project is worth pursuing, making it a cornerstone of financial decision-making. Interpreting NPV results is straightforward but crucial. If NPV is greater than 0, the project is acceptable. It promises the required rate of return and increases the company's market value. If NPV is less than 0, the project is not acceptable as it fails to meet the return threshold and would decrease market value. When NPV equals 0, the project is neutral. Accepting it neither increases nor decreases the company's value. This clear-cut rule helps managers make confident investment decisions, focusing on projects that truly add value. Internal rate of return, IRR, is another popular investment evaluation tool, but it comes with its own set of challenges. For example, if the opportunity cost of capital is lower than the IRR, the NPV is positive. If it matches the IRR, NPV is 0. If it's higher, NPV turns negative. Sometimes projects can have multiple IRRs, making it tricky to interpret results. Additionally, when comparing mutually exclusive projects, IRR might favor one project over another, even if the second is more profitable. It's essential to always cross-check IRR findings with NPV for a complete picture. Some investment projects can have more than one IRR, especially when cash flows change direction more than once. In such cases, the project is only acceptable for opportunity costs that fall between the two IRRs. This complexity can confuse decision makers and lead to incorrect conclusions if not handled carefully. That's why it's important to understand the cash flow structure of a project and use NPV as a cross-reference. By doing so, investors can avoid costly mistakes and make more informed choices. Evaluating mutually exclusive projects, relying solely on IRR can be misleading. The IRR rule might rank one project higher, even if another project would actually generate more wealth. This happens because IRR doesn't always account for the scale or timing of cash flows. To avoid this pitfall, it's best to use NPV as the primary criterion, as it directly measures value creation. This approach ensures that the chosen project truly maximizes shareholder value. Another challenge with IRR is dealing with the time structure of discount rates. The IRR must always be compared to the opportunity cost of capital, which is essentially the discount rate. If the discount rate changes over time, IRR may not provide an accurate assessment. That's why it's important to use a consistent and realistic discount rate when evaluating projects. This ensures that investment decisions are based on solid financial ground, reducing the risk of unexpected outcomes. Profitability Index, PI, is a relative measure that compares the present value of future cash inflows to the initial investment. It's calculated by dividing the present value of forecasted cash flows by the initial investment. If the index is greater than 1, the project is considered acceptable. This method is especially useful when comparing projects of different sizes, as it provides a standardized way to assess investment efficiency. By focusing on relative returns, PI helps managers prioritize projects that deliver the most value per dollar invested. Let's look at the formula for the profitability index. You take the present value of all expected cash flows and divide it by the initial investment. The key variables are the initial investment, C0, the cash flows in each year, CFI, the discount rate, R, and the project's lifespan, N. The rule is simple: accept all projects with a PI greater than 1. This ensures that every dollar invested generates more than a dollar in present value returns, making it a practical tool for capital budgeting. Discounted payback period, DPP, measures how long it takes for the cumulative discounted cash flows to equal the initial investment. Unlike the simple payback period, DPP accounts for the time value of money, providing a more accurate picture of risk and return. However, it has its limitations. DPP ignores the order of cash flows and doesn't consider returns beyond the payback point. It's best used when the payback period doesn't exceed the project's lifespan, ensuring that the investment is recovered within a reasonable timeframe. Discounted payback period is most useful when you want to ensure that your investment is recovered within the project's expected lifespan. If the DPP is shorter than or equal to the project's life, it's a good sign. However, if the DPP exceeds the project's lifespan, the method loses its relevance. In such cases, it's better to rely on other evaluation methods like NPV or IRR. Understanding when to use DPP helps managers avoid misjudging the risk and timing of their investments. Calculate the discounted payback period. You sum the discounted cash flows year by year until the total equals the initial investment. This approach provides a clear timeline for when the investment is expected to be recovered, factoring in both time and risk. It's a straightforward method that helps managers assess the liquidity and safety of a project. However, remember that it doesn't account for cash flows after the payback point, so it should be used alongside other evaluation tools. Main difference between the simple payback period and the discounted payback period is how they treat time and risk. The simple payback period ignores the time value of money, treating all cash flows as equal. In contrast, the discounted payback period adjusts each cash flow for time and risk, providing a more realistic assessment. This distinction is important for projects with long timelines or significant uncertainty, as it ensures that investment decisions are based on accurate financial information. Personnel management is the internal system for planning, controlling, analyzing, and evaluating personnel activities within a company. It focuses on the costs associated with human resources, the quality of those resources, and potential risks that may arise. The goal is to provide a detailed description of employees, including their numbers, structure, wage costs, performance, motivation, leadership skills, and ability. Effective personnel management ensures that the organization has the right people in the right roles, supporting overall business success. Human Resources Budget provides valuable information about the company's workforce. It details the number of employees, their structure, wage costs, and other expenses related to personnel. This budget helps managers plan for future staffing needs, control labor costs, and ensure that the organization remains competitive. By analyzing HR budget data, companies can identify trends, address potential issues, and make informed decisions about hiring, training, and development. Hiring new employees has a direct financial impact on a company. Recruitment costs, onboarding expenses, and initial training all add up. However, bringing in new talent can also drive innovation and growth. It's important for managers to weigh these costs against the potential benefits, ensuring that each hiring decision supports the company's long-term goals. By carefully managing the hiring process, organizations can maximize the return on their investment in human capital. Investing in the training and development of existing employees also carries financial implications. While training programs require time and resources, they can significantly boost employee performance and motivation. Well-trained staff are more productive, adaptable, and likely to stay with the company. Managers must evaluate the costs of training against the expected improvements in efficiency and job satisfaction, ensuring that development initiatives deliver real value. Strategic planning is essential when investing in human resources. Companies need to forecast future staffing needs, identify skill gaps, and allocate resources for recruitment and training. By taking a proactive approach, organizations can ensure they have the talent required to meet business objectives. This planning process also helps control costs and minimize risks, creating a more resilient and adaptable workforce. Controlling human resource costs is a key part of personnel management. This involves monitoring wage expenses, benefits, and other labor-related costs to ensure they stay within budget. Effective cost control allows companies to invest in other areas of the business, supporting growth and innovation. Regular analysis of HR spending helps identify inefficiencies and opportunities for savings, making the organization more competitive. Analyzing the structure of the workforce provides insights into the company's strengths and weaknesses. By examining employee roles, experience levels, and skill sets, managers can identify areas for improvement and development. This analysis supports better decision-making around promotions, training, and recruitment, ensuring that the organization has the right mix of talent to achieve its goals. Evaluating employee performance is a critical function of personnel management. Regular performance reviews help identify high performers, address areas for improvement, and set goals for future development. By linking performance to compensation and career progression, companies can motivate employees to excel and align their efforts with organizational objectives. This process also supports succession planning and leadership development. Motivation and leadership are essential for building high-performing teams. Effective leaders inspire employees, foster collaboration, and create a positive work environment. By understanding what drives their teams, managers can implement strategies that boost engagement and productivity. This not only improves individual performance but also contributes to the overall success of the organization. Continuous skill development is vital in today's fast-changing business environment. Companies that invest in employee learning stay ahead of the competition and adapt more easily to new challenges. Training programs, workshops, and on-the-job learning opportunities help employees acquire new skills and enhance their existing ones. This commitment to development benefits both the individual and the organization. Workforce risks can arise from various sources, such as skill shortages, turnover, or changes in labor laws. Effective personnel management involves identifying these risks early and developing strategies to mitigate them. This might include succession planning, cross-training, or investing in employee well-being. By proactively managing risks, companies can maintain stability and ensure long-term success. Succession planning ensures that key roles within the organization are always filled by qualified individuals. By identifying and developing future leaders, companies can reduce the impact of unexpected departures and maintain continuity. This process involves assessing current talent, providing targeted development opportunities, and creating clear career paths. Succession planning is a strategic investment in the company's future. Motivating employees requires a mix of financial and non-financial incentives. Competitive salaries, bonuses, and benefits are important, but so are recognition, career development, and a positive work environment. Managers should tailor motivation strategies to the needs of their teams, fostering a culture of engagement and achievement. This holistic approach leads to higher job satisfaction and better business results. Linking compensation to performance is a powerful way to drive results. By rewarding employees for meeting or exceeding goals, companies can encourage high performance and align individual efforts with organizational objectives. Performance-based pay structures should be transparent, fair, and tied to clear metrics. This approach helps attract and retain top talent while promoting a culture of excellence. Diverse workforce brings a wide range of perspectives, ideas, and experiences to the organization. Embracing diversity can lead to greater creativity, better problem-solving, and improved business performance. Companies that value diversity are also more attractive to top talent and better equipped to serve diverse markets. Building an inclusive culture is an ongoing process that requires commitment from all levels of the organization. Retaining top talent is essential for long-term success. Companies can improve retention by offering competitive compensation, opportunities for growth, and a supportive work environment. Regular feedback, recognition, and career development programs also play a key role. By understanding what motivates employees to stay, organizations can reduce turnover and build a loyal, high-performing workforce. HR analytics involves using data to inform personnel decisions. By analyzing trends in hiring, turnover, performance, and engagement, managers can make more informed choices about recruitment, training, and development. This data-driven approach helps companies optimize their workforce, improve efficiency, and achieve better business outcomes. Labor market is constantly evolving with new trends and challenges emerging all the time. Companies must stay agile, adapting their personnel strategies to changing conditions. This might involve updating job roles, offering flexible work arrangements, or investing in new technologies. By staying ahead of labor market trends, organizations can attract and retain the best talent. Compliance with labor laws and regulations is a fundamental aspect of personnel management. Companies must stay up to date with legal requirements related to hiring, compensation, benefits, and workplace safety. Failing to comply can result in costly penalties and damage to the company's reputation. Regular training and audits help ensure that HR practices remain compliant and ethical. Technology is transforming the way companies manage their human resources. HR software streamlines processes like recruitment, payroll, and performance management, saving time and reducing errors. Digital tools also enable better communication and collaboration among teams. By embracing technology, organizations can improve efficiency and provide a better experience for employees. Remote work has become increasingly popular, offering benefits like flexibility and access to a wider talent pool. However, it also presents challenges in terms of communication, collaboration, and maintaining company culture. Managers must develop strategies to support remote teams, ensuring that employees stay connected and engaged no matter where they work. Supporting employee well-being is more important than ever. Wellness programs, mental health resources, and flexible work arrangements can help employees manage stress and maintain a healthy work-life balance. Companies that prioritize well-being see higher engagement, lower turnover, and better overall performance. Investing in well-being is a win-win for both employees and the organization. Attracting top talent requires a strategic approach. Companies must build a strong employer brand, offer competitive compensation, and create a positive candidate experience. Leveraging social media, employee referrals, and targeted recruitment campaigns can help reach the best candidates. A well-executed talent acquisition strategy ensures that the organization has the skills needed to succeed. Effective onboarding sets new employees up for success. A structured onboarding program introduces new hires to the company culture, clarifies expectations, and provides the training needed to perform well. By making new employees feel welcome and supported, companies can accelerate their integration and improve retention rates. Providing clear career development paths helps employees see a future with the company. Career planning, mentorship, and regular feedback encourage employees to grow and take on new challenges. This not only boosts engagement but also ensures that the organization has a pipeline of skilled talent ready to step into key roles. Measuring the effectiveness of HR initiatives is essential for continuous improvement. Key performance indicators, KPIs like turnover rates, employee satisfaction, and training ROI provide valuable insights. Regularly tracking these metrics helps managers identify what's working and where adjustments are needed, ensuring that HR strategies deliver real value. For HR to be truly effective, it must align with the company's overall business strategy. This means ensuring that personnel policies, recruitment, and development initiatives support the organization's mission and objectives. By working closely with other departments, HR can help drive business growth and create a competitive advantage. Continuous improvement is key to staying competitive in today's fast-paced business world. HR departments should regularly review and update their policies, processes, and programs to reflect changing needs and best practices. By fostering a culture of learning and innovation, companies can adapt quickly and maintain a high-performing workforce. In summary, evaluating investments and managing human resources are both critical for business success. By understanding concepts like discounting, NPV, IRR, and profitability index, managers can make informed financial decisions. At the same time, effective personnel management ensures that the company has the talent and motivation needed to achieve its goals. Combining strong financial analysis with strategic HR practices creates a solid foundation for long-term growth and competitiveness. Every successful company relies on careful planning for its future expenses, revenues, and cash flow. This process is known as budgeting. A well-structured budget helps organizations anticipate their financial needs, allocate resources efficiently, and set realistic goals. In this video, we'll explore the key elements of company budgets, with a special focus on human resources. We'll also discuss how different types of costs impact a company's financial health and decision-making. Let's start by understanding why budgeting is so crucial for any business, large or small, and how it lays the foundation for sustainable growth. Human resources form a significant part of a company's overall expenses. When creating a budget, it's essential to consider not just salaries, but also social and health insurance, bonuses, rewards, and training costs. These elements ensure that employees are motivated, skilled, and well taken care of. HR budgeting isn't just about numbers, it's about investing in people, which ultimately drives productivity and company success. By accurately forecasting these costs, companies can avoid surprises and maintain a healthy balance between rewarding employees and managing expenses. One important distinction in company expenses is between tax-deductible and non-deductible costs. Tax-deductible costs allow a company to reduce its taxable income, effectively lowering the amount of tax owed. On the other hand, non-deductible costs do not provide this benefit. Understanding which expenses fall into each category is vital for accurate financial planning and compliance. For example, while certain operational costs may be deductible, others, like some entertainment expenses, may not be. This distinction directly affects a company's reported profit and tax obligations. A company needs to fill a position, it can look within its existing workforce. Internal recruitment has several advantages. It's usually faster and less expensive as there's no need for extensive advertising or onboarding. Internal candidates already understand the company culture and work environment, making transitions smoother. However, the pool of candidates is limited, and promoting from within can sometimes lead to jealousy or competition among employees. Balancing these factors is key to making the right hiring decisions. Alternatively, companies can search for new talent outside their organization. External recruitment brings fresh perspectives and new ideas, which can drive innovation and growth. There's a wider selection of candidates, increasing the chances of finding the perfect fit. However, this process is often more expensive and time-consuming, involving advertising, resume screening, interviews, and onboarding. New hires may also take time to adapt to the company's culture and value. Weighing these pros and cons helps companies choose the best approach for each situation. Some types of employee training are required by law to ensure workplace safety and compliance. Examples include occupational health and safety training, fire protection courses, and specialized training for employees operating forklifts or working with electricity. These mandatory trainings protect both employees and the company, reducing the risk of accidents and legal issues. Investing in such training is not just a legal obligation but also a smart business move, as it fosters a safer and more productive work environment. Not all employee-related expenses are tax-deductible. For instance, costs for non-mandatory training, meal allowances above the legal limit, or company parties are typically considered non-deductible. While these expenses can boost morale and team spirit, they don't provide tax benefits. Companies must carefully track and categorize such costs to ensure accurate financial reporting and avoid issues during audits. Understanding the distinction helps businesses make informed decisions about employee benefits and company events. Labor productivity measures how efficiently a company turns labor into goods or services. It's typically calculated as the volume of output per unit of labor over a specific period, such as a year, month, day, or hour. High productivity means the company is making the most of its workforce, which is crucial for competitiveness and profitability. Monitoring productivity helps managers identify areas for improvement and optimize resource allocation. It's a key indicator of operational efficiency and business health. Added value represents the wealth a company creates through its operations. It's calculated as the revenue from sales minus costs like wages and insurance. In other words, it's the difference between what a company earns and what it spends on inputs. Added value can be increased by boosting sales or minimizing input costs. This metric is essential for understanding a company's profitability and its contribution to the economy. It also guides strategic decisions on pricing, investment, and cost management. Production inputs are the basic resources a company uses to create goods or services. These include land, labor, and capital. The outputs are the finished products or services delivered to the market, along with any emissions or byproducts. Understanding the relationship between inputs and outputs is fundamental for managing efficiency and sustainability. Companies strive to maximize outputs while minimizing inputs, which leads to higher productivity and lower costs. This balance is at the heart of effective production management. Productivity is often measured using ratios that compare outputs to inputs. For example, labor productivity can be calculated as added value divided by the number of employees or hours worked. These ratios provide valuable insights into how effectively a company uses its resources. The higher the ratio, the more efficiently the company operates. Regularly tracking these metrics helps managers identify trends, set targets, and drive continuous improvement across the organization. Productivity can be measured over different time frames, such as daily or hourly. Daily productivity shows how many products an employee produces in one day, while hourly productivity breaks it down even further. These metrics help managers understand workforce efficiency and identify peak performance periods. By analyzing productivity at various intervals, companies can optimize work schedules, allocate resources more effectively, and set realistic performance goals for their teams. Full-time equivalent, or FTE, is a standard way to measure the workforce. It represents the number of full-time employees or the equivalent in part-time workers. For example, 2 half-time employees equal 1 FTE. This metric is useful for comparing productivity, costs, and revenues on a consistent basis. It also helps companies plan staffing levels, manage workloads, and benchmark against industry standards. Understanding FTE is essential for accurate HR and financial analysis. Revenue per employee is a key indicator of how much income each worker generates for the company. It's calculated by dividing total revenues by the number of full-time equivalent employees. This metric helps managers assess workforce efficiency and compare performance across departments or with competitors. High revenue per employee usually signals effective use of human resources and strong business performance. Tracking this ratio over time can reveal trends and highlight areas for improvement. Total cost per employee measures how much a company spends on each worker, including salaries, benefits, and other expenses. It's calculated by dividing total costs by the number of full-time equivalent employees. This metric is crucial for budgeting, cost control, and profitability analysis. By understanding the total cost per employee, companies can make informed decisions about hiring, compensation, and resource allocation. It also helps identify opportunities to improve efficiency and reduce unnecessary expenses. Ratio of reward costs to revenue shows how much a company spends on wages and employee benefits compared to its total income. It's calculated by adding wage costs and employee benefits, then dividing by total revenue. This ratio helps managers evaluate whether compensation levels are sustainable and aligned with business performance. Keeping this ratio in check ensures that the company remains competitive while still rewarding its employees appropriately. Another important metric is the ratio of reward costs to total company costs. This calculation compares the sum of wage costs and employee benefits to the company's overall expenses. It helps managers understand how much of the budget is devoted to rewarding employees. Monitoring the ratio supports better budgeting and ensures that compensation remains balanced with other business priorities. It's a valuable tool for financial planning and HR strategy. Company costs can be classified in several ways. From an accounting perspective, costs are often divided into operating and financial categories. Operating costs include materials, energy, taxes, and insurance, essential for day-to-day business. Financial costs cover items like loan interest and bank fees. Understanding these categories helps companies manage their finances more effectively and make informed decisions about spending and investment. Tax-deductible costs are those that can be subtracted from a company's taxable income. Common examples include material consumption and the cost of goods sold. These expenses are directly related to the company's core business activities. By maximizing tax-deductible costs, companies can reduce their tax burden and improve profitability. It's important to document these expenses carefully to ensure compliance with tax regulations and avoid potential penalties. Non-deductible costs cannot be used to reduce taxable income. Examples include representation expenses, fines, and cert fees. These costs are often related to activities that are not directly tied to the company's main business operations. While they may be necessary or beneficial in some cases, they do not provide tax advantages. Companies should track these expenses separately to ensure accurate financial reporting and compliance with tax law. Distinction between tax-deductible and non-deductible costs directly affects a company's reported profits. Deductible costs lower the taxable base, reducing the amount of tax owed and increasing net profit. Non-deductible costs, however, do not provide this benefit, which can result in higher tax payments and lower reported profits. Understanding this impact is crucial for accurate financial planning and strategic decision-making. Costs can also be classified as direct or indirect. Direct costs are those that can be specifically attributed to a product or service, such as raw materials and direct wages. These costs vary directly with production volume. Indirect costs, on the other hand, are shared across multiple products or services and include items like lighting, heating, repairs, and administrative salaries. Understanding the difference helps companies allocate costs accurately and price their products competitively. Direct costs are easy to trace to a specific product or service. Common examples include direct materials, direct wages, and other direct expenses. These costs fluctuate with the level of production, making them a key focus for cost control and efficiency improvements. By managing direct costs effectively, companies can improve margins and remain competitive in their markets. Direct costs, also known as overheads, are not directly linked to a specific product. These include expenses like lighting, heating, repairs, lubricants, depreciation, travel, and administrative salaries. Indirect costs are necessary for running the business but are spread across all products or services. Managing overheads is essential for maintaining profitability and ensuring that prices reflect the true cost of doing business. To determine the total cost of a product, companies use a calculation formula that includes direct materials, direct wages, and other direct costs. On top of these, manufacturing overheads are added to arrive at the total production cost. This formula ensures that all relevant expenses are captured, providing a clear picture of product profitability. Accurate cost calculation is vital for pricing, budgeting, and financial planning. Manufacturing overheads, also known as production overheads, include all indirect costs associated with the production process. These might involve factory utilities, maintenance, and supervisory salaries. Overheads are allocated across all products, ensuring that each item bears a fair share of the total production costs. Properly managing overheads helps companies control expenses and improve profitability. Administrative overheads cover the indirect costs of running the business, such as office expenses, management salaries, and support services. These costs are necessary for the company's operations but are not directly tied to production. Allocating administrative overheads accurately ensures that product pricing reflects the true cost of doing business and supports sound financial management. Distribution overheads are the costs associated with delivering products to customers. These include shipping, logistics, and sales expenses. Properly accounting for distribution overheads ensures that the full cost of getting products to market is reflected in pricing and profitability analysis. Efficient distribution management can also lead to cost savings and improved customer satisfaction. Company's total cost structure includes direct costs, manufacturing overheads, administrative overheads, and distribution overheads. By understanding and managing each component, businesses can optimize pricing, control expenses, and maximize profitability. A comprehensive approach to cost management supports long-term success and competitiveness in the market. After calculating all relevant costs, companies add a profit margin to determine the final price of their products or services. This process ensures that prices cover all expenses and generate a return for the business. Accurate profit calculation is essential for sustainability and growth, helping companies remain competitive while achieving their financial goals. Managers often classify costs based on how they support decision-making. This approach considers factors like controllability, relevance, and behavior. For example, managers may focus on variable versus fixed costs or controllable versus uncontrollable expenses. This classification helps in budgeting, forecasting, and performance evaluation, enabling more effective management of company resources. Variable costs change with the level of production, such as raw materials and direct labor. Fixed costs, on the other hand, remain constant regardless of output, like rent and salaries. Understanding the difference between variable and fixed costs is crucial for budgeting, pricing, and profitability analysis. It also helps managers make informed decisions about scaling production and managing risk. Controllable costs are those that managers can influence, such as discretionary spending on supplies or overtime. Uncontrollable costs, like taxes or regulatory fees, are outside the manager's direct control. Distinguishing between these types of costs helps managers focus their efforts on areas where they can make the most impact and improve overall efficiency. Relevant costs are those that will be affected by a specific business decision, such as the cost of materials for a new product line. Irrelevant costs, like sunk costs, do not change regardless of the decision made. Focusing on relevant costs ensures that managers base their decisions on the most impactful information, leading to better outcomes for the company. Analyzing how costs behave in relation to changes in business activity is essential for effective management. Some costs increase directly with production while others remain stable. By understanding cost behavior, managers can forecast expenses more accurately, set appropriate budgets, and make strategic decisions about scaling operations or introducing new products. Cost allocation involves assigning indirect costs to products or services. Common methods include activity-based costing, which allocates overheads based on actual activities, and traditional costing, which uses simpler allocation bases. Choosing the right method ensures that product costs are accurate, supporting better pricing and profitability analysis. Uncertainty is a constant in business, making it important to build flexibility into budgets. Companies can use contingency funds, scenario planning, and regular budget reviews to adapt to changing conditions. This proactive approach helps businesses stay resilient and respond effectively to unexpected challenges or opportunities. Accurate forecasting is the backbone of effective budgeting and cost management. By analyzing historical data, market trends, and internal performance, companies can make informed predictions about future expenses and revenues. This enables better resource allocation, risk management, and strategic planning, supporting long-term business success. Effective cost control is essential for maintaining profitability. Techniques include setting spending limits, monitoring expenses regularly, and implementing approval processes for major purchases. By fostering a culture of cost awareness, companies can identify savings opportunities and avoid unnecessary expenditures, strengthening their financial position. Engaging employees in cost management initiatives can lead to significant savings and process improvements. Encouraging staff to suggest cost-saving ideas, participate in efficiency projects, and take ownership of budgets fosters a sense of responsibility and teamwork. This collaborative approach not only reduces costs but also boosts morale and innovation. Modern technology plays a vital role in managing company costs. Tools like accounting software, data analytics, and automation streamline processes, improve accuracy, and provide real-time insights. Investing in the right technology enables companies to track expenses, forecast trends, and make data-driven decisions, ultimately enhancing financial performance. Cost management is an ongoing process that requires regular review and adaptation. Companies should continuously seek ways to improve efficiency, reduce waste, and optimize resource use. By fostering a culture of continuous improvement, businesses can stay agile, respond to market changes, and maintain a competitive edge. Effective cost management goes beyond simple expense tracking. It's a strategic tool that supports decision-making, drives profitability, and enables growth. By aligning cost management with business objectives, companies can invest in innovation, expand into new markets, and build long-term value for stakeholders. In summary, understanding and managing company costs is essential for business success. From budgeting and cost classification to productivity measurement and strategic decision-making, each aspect plays a vital role in financial health. By applying the concepts and techniques discussed in this video, companies can optimize their operations, improve profitability, and achieve their long-term goals. Remember, effective cost management is a continuous journey that requires attention, adaptation, and collaboration across the organization. As we look to the future, companies must remain proactive in managing costs and adapting to changing business environments. Embracing new technologies, fostering a culture of innovation, and investing in employee development are key strategies for long-term success. By staying focused on financial discipline and continuous improvement, businesses can navigate challenges, seize opportunities, and build a strong foundation for sustainable growth. Start by understanding the two main types of costs every business faces: explicit and implicit costs. Explicit costs are those that involve direct payments to others, such as rent paid to a landlord or salaries paid to employees. These are out-of-pocket expenses that are easily tracked in your accounting records. On the other hand, implicit costs represent the opportunity costs of using resources you already own. For example, if you use your own building for your business, the potential rental income you forego is an implicit cost. Recognizing both types is crucial for a complete picture of your business expenses. Explicit costs are straightforward and easy to identify. These are the expenses that require a direct outflow of cash from your business. Think of things like paying rent for your office space, purchasing raw materials, or paying utility bills. Each of these transactions is recorded in your financial statements and can be traced back to a specific payment. Tracking explicit costs helps you manage your cash flow and ensures you have enough funds to cover your daily operation. Implicit costs, while less visible, are just as important. These are the costs associated with using your own resources instead of renting or selling them. For instance, if you own a building and use it for your business, you miss out on the rental income you could have earned. Similarly, if you invest your own money in your business, you forego the interest or returns you might have received elsewhere. Including implicit costs in your calculations gives you a more accurate measure of your business's true profitability. Now let's distinguish between fixed and variable costs. Fixed costs remain constant regardless of how much you produce. Examples include rent, insurance, and salaries for permanent staff. These costs do not change even if your production volume increases or decreases. In contrast, variable costs fluctuate with your level of production. The more you produce, the higher your variable costs, such as raw materials and hourly wage. Understanding this distinction helps you plan and control your expenses more effectively. Visualizing costs can make it easier to understand how they behave as production changes. On a graph, fixed costs appear as a horizontal line, showing that they stay the same no matter the output. Variable costs, however, start at zero and increase as production rises, forming an upward sloping line. By combining these, you get the total cost curve, which helps you see how your expenses grow with increased production. This graphical approach is a powerful tool for decision-making. Two important cost concepts are average cost and marginal cost. Average cost is calculated by dividing total costs by the number of units produced. It tells you how much, on average, each unit costs to make. Marginal cost, on the other hand, measures the increase in total cost when you produce one more unit. This is crucial for pricing and production decisions, as it helps you determine the most cost-effective level of output. Find the average cost. Simply divide your total costs by the quantity of goods produced. For example, if your total costs are $1,000 and you produce 100 units, your average cost per unit is $10. This calculation helps you understand how efficiently you are producing and whether you can lower costs by increasing output. Monitoring average cost over time can reveal trends and opportunities for improvement. Marginal cost is all about change. It tells you how much your total costs will increase if you produce just one more unit. The formula is simple: change in total cost divided by change in quantity. For example, if producing one extra unit increases your total cost by $5, then your marginal cost is $5. This information is vital for deciding whether to expand production or hold back. Businesses use several methods to model and predict costs. The classification method separates total costs into fixed and variable components, making it easier to analyze. The two-period method uses data from 2 different years to estimate cost behavior. Graphical methods involve plotting cost curves to visualize trends, while regression methods use software like Excel to analyze historical data and forecast future costs. Each approach has its strengths and is chosen based on the available data and business needs. Cost models help businesses answer critical questions. How much do we need to produce to break even? What price should we set to ensure profitability? How do changes in fixed or variable costs affect our bottom line? By modeling costs, companies can make informed decisions about production, pricing, and investment, reducing the risk of losses and maximizing profits. Break-even analysis is a fundamental tool for any business. It identifies the point where your total revenues equal your total costs, meaning you're neither making a profit nor a loss. This is known as the break-even point. Understanding where this point lies helps you set sales targets and make strategic decisions about pricing and production volumes. Calculate the break-even point. Use the formula: fixed costs divided by price per unit minus variable cost per unit. This tells you how many units you need to sell to cover all your costs. If you want to include a target profit, simply add the desired profit to your fixed costs in the formula. These calculations are essential for planning and evaluating business performance. Break-even analysis can be visualized with both linear and nonlinear graphs. In a linear scenario, costs and revenues increase at a constant rate, making the break-even point easy to spot. However, in reality, costs or revenues may not always behave linearly. Nonlinear graphs account for changes in cost structure or pricing, providing a more accurate picture for complex businesses. Analyzing cost and price limits helps businesses understand how much their fixed or variable costs can increase before profitability is threatened. For example, you can calculate the maximum allowable increase in fixed costs or variable costs to ensure your company remains profitable. Similarly, you can determine the minimum price you need to charge to cover all expenses and achieve your financial goals. There are specific formulas to calculate these limits. For fixed costs, the limit is calculated as quantity times price minus variable cost minus minimum profit. For variable costs, the formula is price minus fixed cost plus minimum profit divided by quantity. For price limits, it's variable cost plus fixed cost plus minimum profit divided by quantity. These formulas help you plan for different scenarios and ensure your business stays on track. Financing investment projects can be done using your own capital or borrowed funds. Using your own capital means relying on retained earnings, current profits, or company reserves. This approach gives you more control and avoids paying interest, but it can be more expensive in the long run compared to external financing. Choosing the right mix depends on your business goals and financial situation. Internal financing involves using the company's own resources, such as profits or reserve funds, to finance operations or investments. While this method avoids the risks and costs associated with borrowing, it can limit the amount of capital available for growth. Businesses must weigh the benefits of independence against the potential for slower expansion when relying solely on internal funds. Depreciation represents the gradual loss of value of your assets over time due to wear and tear. It's an accounting method that spreads the cost of an asset over its useful life. Accumulated depreciation is the total amount that has been depreciated so far, while the book value is the current value of the asset after accounting for depreciation. Understanding depreciation helps you manage your assets and plan for replacement. There are two main methods for calculating depreciation: straight line and accelerated. The straight line method spreads the cost evenly over the asset's life, with the first year often having a different rate. Accelerated depreciation allows for higher deductions in the early years, which can be beneficial for tax purposes. Choosing the right method depends on your business strategy and tax planning needs. With straight-line depreciation, you calculate the annual depreciation by multiplying the asset's purchase cost by the depreciation rate for the first year. After that, the depreciation amount remains the same each year. This method is simple and provides predictable expense amounts, making it popular for many businesses. Accelerated depreciation allows you to write off more of an asset's value in the early years of its life. In the first year, you divide the initial cost by a coefficient. For subsequent years, you multiply twice the remaining book value by the coefficient, adjusted for the number of years left. This method can reduce taxable income in the short term, which is useful for businesses looking to reinvest savings. Depreciation can also be based on the asset's useful life. The depreciation rate is calculated as 100 divided by the number of years the asset is expected to last. The annual depreciation is then the purchase price multiplied by this rate. This approach allows businesses to match depreciation expenses with the actual usage of their assets. Another method is to depreciate assets based on their performance, such as the number of units produced. The unit depreciation is calculated by dividing the purchase price by the total expected output. Annual depreciation is then the unit depreciation multiplied by the number of units produced in a year. This method is ideal for assets whose wear depends on usage rather than time. Self-financing refers to using internal resources such as retained earnings and company funds to finance operations or investments. The main advantage is that it's low risk and doesn't require paying interest. However, it can be more expensive than external financing and may limit the amount of profit available for distribution to owners or reinvestment. Biggest advantage of self-financing is that it doesn't involve borrowing, so there's no risk of default or additional interest costs. It also gives the business more independence and flexibility in decision-making. However, relying solely on internal funds can slow down growth and reduce the amount of profit available for other uses. While self-financing is safe, it can be more expensive than using external funds. External capital is often cheaper, especially if interest rates are low. Additionally, using internal funds means less money is available for profit distribution or future investments, which can impact long-term business growth and shareholder satisfaction. Reserve funds are set aside to cover unexpected events such as equipment breakdowns or sudden drops in revenue. While not always mandatory, having a reserve fund provides a safety net for your business. It allows you to quickly address emergencies without disrupting operations or taking on debt. There's an important distinction between reserves and reserve funds. Reserves can be used as internal sources of financing for investments, giving businesses flexibility in managing their finances. Reserve funds, however, are typically restricted and can only be used for specific purposes, such as covering losses or replacing damaged equipment. External equity financing involves raising capital by issuing shares to new or existing investors. This can be done through public offerings, private placements, or rights issues. The main advantage is that it increases the company's capital without increasing debt. However, it can dilute existing ownership and may come with higher costs compared to borrowing. Preferred shares are a type of equity security that gives holders priority when it comes to dividends. They have no maturity date and provide a steady income stream, making them attractive to certain investors. The main advantage is that they allow companies to raise capital without giving up control. However, preferred shares are usually more expensive and dividends are not tax deductible. Common shares represent regular ownership in a company. Shareholders have the right to vote on company matters, receive dividends, and share in the company's assets if it's liquidated. Companies can issue new shares through public or private offerings or through rights issues to existing shareholders. The main advantage is limited liability, as shareholders are only responsible for unpaid amounts on their shares. Companies can issue shares in several ways, through public offerings, private placements, or rights issues. Public offerings make shares available to anyone, while private placements target specific investors. Rights issues give existing shareholders the first chance to buy new shares. Each method has its own advantages and is chosen based on the company's needs and market conditions. Equity financing increases your company's capital without adding debt, reducing financial risk. It also allows you to attract new investors and share business risks. However, it can dilute existing ownership and may require sharing control with new shareholders. Balancing these factors is key to a successful financing strategy. While equity financing can provide much-needed capital, it often comes at a higher cost than debt financing. Dividends paid to shareholders are not tax-deductible, and issuing new shares can reduce the ownership percentage of existing shareholders. Companies must carefully consider these trade-offs when deciding how to raise funds. There are several types of shares a company can issue. Preferred shares offer fixed dividends and priority over common shares. Common shares provide voting rights and a share in profits. Some companies may also issue special classes of shares with unique rights or restrictions. Understanding the differences helps investors make informed decisions. Shareholders have various rights depending on the type of shares they hold. Common shareholders can vote at general meetings, receive dividends, and participate in the company's growth. Preferred shareholders usually have priority for dividends but may not have voting rights. These rights are outlined in the company's bylaws and share agreements. The process of issuing shares involves several steps. First, the company decides how many shares to issue and at what price. Then, it prepares the necessary legal documents and registers the shares with the relevant authorities. Finally, the shares are offered to investors through the chosen method. This process ensures transparency and protects both the company and its investors. One of the key benefits of owning shares is limited liability. Shareholders are only responsible for the unpaid portion of their shares, meaning their personal assets are protected. This encourages investment and supports business growth by reducing the risks for individual investors. Dividends are payments made to shareholders from the company's profits. Preferred shareholders usually receive fixed dividends, while common shareholders may receive variable amounts based on the company's performance. Dividends provide a steady income for investors and can make shares more attractive. Shareholders can influence company decisions through their voting rights. Major decisions, such as mergers or changes to the company's structure, often require shareholder approval. This gives investors a say in how the company is run and helps align management's interests with those of the owners. Annual general meetings are an important part of corporate governance. Shareholders gather to review the company's performance, vote on key issues, and ask questions of management. These meetings promote transparency and allow shareholders to stay informed about their investments. The ultimate goal of any business is to maximize shareholder value. This means increasing the company's profitability, share price, and dividend payments over time. By focusing on value creation, companies can attract more investors and ensure long-term success. We've covered a lot of ground, from understanding different types of costs and how to model them, to exploring various financing methods and the role of shares in raising capital. Each concept plays a vital role in business decision-making and financial planning. Mastering these fundamentals will help you build a stronger, more resilient business. Now that you have a solid understanding of cost structures, financing options, and shareholder rights, you're better equipped to make informed business decisions. Whether you're managing a small company or a large corporation, these principles will guide you toward sustainable growth and financial success. As you continue your journey in business and finance, remember that staying informed and adaptable is key. The concepts we've discussed form the foundation for more advanced topics such as investment analysis, risk management, and strategic planning. Keep building your knowledge and you'll be ready to tackle any financial challenge that comes your way. Welcome to our comprehensive guide on capital funding. In this video, we'll explore the essential methods companies use to raise money for their operations and growth. Whether you're a student, entrepreneur, or just curious about how businesses finance themselves, you'll find valuable insights here. We'll start by looking at the different types of shares, move on to the costs involved, and then dive into various forms of external financing like bonds, loans, and leasing. By the end, you'll have a clear understanding of the advantages and disadvantages of each method and how they fit into the bigger picture of corporate finance. Let's begin our journey into the world of capital funding. Shares are fundamental building blocks of corporate finance. When a company needs to raise capital, it can issue shares to investors. These shares represent ownership in the company and come in different types, each with its own rights and benefits. Understanding the difference between share types is crucial for both companies and investors. In the next scenes, we'll break down the two main categories, preferred shares and common shares. Each serves a unique purpose in the world of finance, and knowing how they work can help you make better financial decisions. Preferred shares, also known as priority shares, are a special type of security with no maturity date. They allow companies to increase their capital without affecting the control held by common shareholders. Holders of preferred shares typically receive fixed dividends before any dividends are paid to common shareholders. However, they usually don't have voting rights in company decisions. This makes preferred shares attractive to investors seeking stable income, while companies benefit from raising funds without diluting control. Let's see how this compares to common shares in the next scene. Common shares are the most widely recognized type of equity. When you own common shares, you have the right to participate in the management of the company, share in its profits, and receive a portion of the company's assets if it's liquidated. Unlike preferred shares, common shareholders usually have voting rights, giving them a say in important company decisions. However, their dividends are not guaranteed and are paid after preferred shareholders. This makes common shares more risky, but also potentially more rewarding if the company performs well. Retained earnings are profits that a company keeps instead of distributing as dividends. But even these funds have a cost, known as the cost of retained earnings. This cost can be estimated using a simple formula. Divide the annual dividend per share by the market price of a common share, multiply by 100, and then add the expected dividend growth. This calculation helps companies decide whether to reinvest profits or seek external funding. Understanding this cost is key for making smart financial decisions. Let's break down the formula for estimating the cost of retained earnings. Cost equals annual dividend per share times 100/market price of common share, plus dividend growth. This formula shows how much it costs a company to use its own profits for reinvestment, rather than paying them out as dividends. By comparing this cost to other financing options, companies can make informed decisions about the best way to fund their growth. When a company issues new shares, it incurs certain costs. These include underwriting fees, legal expenses, and other issuance costs. The cost of issuing shares can be calculated using the formula NP equals annual dividend times 100/market price issuance cost per share. This helps companies understand the true cost of raising capital through equity and compare it to other funding sources. Apart from using their own profits, companies often need to look outside for additional funding. This is known as external or borrowed capital. There are several ways to obtain external capital, each with its own features, benefits, and drawbacks. In the following scenes, we'll explore the main forms: issuing bonds, taking out loans, project financing, public funding, and leasing. Understanding these options is crucial for any business aiming to grow sustainably. Issuing bonds is a popular way for companies to raise large amounts of capital. A bond is a debt security that represents a promise by the issuer to repay the borrowed amount, plus interest to the bondholder. Bonds have a fixed interest rate and the holder does not participate in the company's profits. This makes bonds attractive for investors seeking predictable returns, while companies benefit from not diluting ownership. However, bonds also come with obligations and risks, which we'll discuss next. Bonds offer several advantages for companies. The interest rate is fixed, making financial planning easier. Interest payments are tax-deductible, creating a tax shield that lowers the overall cost of capital. Importantly, issuing bonds does not increase the number of company owners, so control remains unchanged. These features make bonds a strategic choice for companies seeking to raise funds without giving up control or facing unpredictable costs. Despite their benefits, bonds also have drawbacks. Companies must make interest payments on time regardless of their financial situation. This can be challenging if profits fall. Additionally, issuing bonds increases the company's debt, which can raise the cost of future borrowing and impact financial stability. Understanding these risks is essential before choosing bonds as a funding method. Loans and credits are another common way for companies to access external capital. These are formal agreements between a lender and a borrower, where the lender provides funds for a set period and the borrower repays in installments. Loans can be tailored to the company's needs, making them flexible. However, they also come with interest costs and repayment obligations, which must be carefully managed. Project financing is used for large, capital-intensive investments. Typically, a special project company is created to manage the project and its finances. This type of financing is secured by the project's assets and future cash flows, rather than the company's overall balance sheet. Project financing often involves a consortium of banks and requires the project to generate enough income to repay the debt and provide returns to investors. Public funding refers to financial support from government budgets or public funds. This support can come in the form of grants, subsidies, or other incentives aimed at promoting long-term economic growth. Public funding is often limited by available resources and strict eligibility criteria, but it can significantly reduce the financial burden on companies, especially for large or innovative projects. Leasing allows companies to use assets without purchasing them outright. Instead, they pay regular lease payments to the asset owner. Leasing can be operational or financial depending on the terms. This method is especially useful for acquiring expensive equipment or vehicles as it preserves cash flow and provides flexibility. However, leasing can be more expensive than buying with a loan, and the company may face restrictions on asset use. Financing with loans offers several advantages. It allows companies to quickly and significantly increase their capital, which is especially important when starting a business. Loans can also boost the efficiency and profitability of a company's own capital. By leveraging borrowed funds, companies can undertake larger projects and potentially achieve higher returns. However, loans also have their downsides. They increase the number of stakeholders who can influence company decisions, raise the company's costs, and require careful liquidity management. If not managed properly, loans can strain a company's finances and limit its flexibility. It's important to weigh these factors before choosing loan financing. Issuing bonds has unique advantages. The interest rate is fixed, making budgeting easier. Interest payments are tax-deductible, which lowers the effective cost of borrowing. Bondholders do not gain ownership or control over the company, so management retains full authority. These benefits make bonds a preferred choice for many companies seeking stable, long-term funding. On the flip side, bond issuance comes with obligations. Companies must make regular interest payments even if profits decline. This can be risky during tough economic times. Additionally, increasing debt through bonds can raise the company's overall financial risk and make future borrowing more expensive. It's crucial to consider these factors when planning a bond issue. Leasing offers several benefits for companies. It allows them to use assets without tying up large amounts of capital. Lease payments are tax-deductible, reducing taxable income. Leasing also lets companies avoid the risks associated with owning assets such as depreciation or obsolescence. This flexibility can be a major advantage, especially for rapidly growing businesses. Despite its benefits, leasing can be more expensive than taking out a loan. At the end of the lease, the company may receive an asset that is worn out or nearly depreciated. Leasing agreements can also restrict how the asset is used, limiting flexibility. Companies should carefully compare the total costs and terms before choosing leasing as a financing option. Project financing is characterized by its focus on a specific investment project. A project company is often established solely for this purpose. The financing is typically secured by the project's assets and future revenues, not the parent company's balance sheet. Multiple banks may be involved, spreading the risk. The project must generate enough cash flow to cover debt payments, provide returns to investors, and build reserves. Direct public support increases a company's resources for investment. This usually comes in the form of investment grants, which provide funds that do not need to be repaid. Direct support is especially valuable for projects that align with government priorities, such as innovation or regional development. However, the amount of support is limited by available public resources. Direct public support focuses on reducing a company's expenses and investment risks. This can include tax breaks, guarantees, or insurance schemes that lower the cost of investing. Indirect support helps companies take on projects they might otherwise avoid due to high risk or cost. It's an important tool for encouraging private investment in key sectors. Public support for business investment can be divided into three main categories. These include direct financial support, indirect support through cost reduction, and targeted support from national or international funds. Each category serves a different purpose and is designed to address specific challenges faced by businesses. Understanding these categories helps companies identify the best opportunities for funding. Selecting the best combination of funding sources is a strategic decision for any company. The right mix depends on factors like the company's size, industry, growth stage, and risk tolerance. Balancing internal and external funding helps companies maintain control, manage costs, and support long-term growth. In the next scenes, we'll look at practical examples and tips for making these decisions. Imagine a startup looking to launch a new product. The founders might use their own savings equity, seek investment from friends and family, or apply for a bank loan. They could also look for government grants or consider leasing equipment to reduce upfront costs. Each option has its own pros and cons, and the best choice depends on the company's goals and resources. Now consider a company planning to expand. They might issue new shares to raise equity, take out a large loan, or issue bonds. Public funding could also play a role, especially if the expansion aligns with government priorities. The company must carefully assess the cost, risk, and impact on control before choosing the best mix of funding sources. Every funding method comes with its own risks. Companies must manage these risks by maintaining a healthy balance between debt and equity, monitoring cash flow, and planning for unexpected events. Good risk management ensures the company can meet its obligations and continue growing, even in challenging times. Financial planning is essential for choosing the right funding sources and managing resources effectively. It involves forecasting future needs, setting budgets, and evaluating different financing options. Strong financial planning helps companies avoid costly mistakes and seize new opportunities as they arise. Company's capital structure refers to the mix of debt and equity it uses to finance its operations. Monitoring and adjusting this structure is key to maintaining financial health. Too much debt can increase risk, while too little can limit growth. Regular reviews help companies stay on track and adapt to changing market conditions. Interest rates play a major role in financing decisions. Higher rates increase the cost of borrowing, making loans and bonds less attractive. Companies must monitor interest rate trends and consider their impact when choosing between debt and equity financing. Smart timing can save significant money over the long term. Different funding methods have different tax implications. For example, interest payments on loans and bonds are usually tax-deductible, while dividends paid to shareholders are not. Leasing payments can also reduce taxable income. Understanding these tax effects helps companies minimize their overall costs and maximize profits. Liquidity refers to a company's ability to meet its short-term obligations. Maintaining adequate liquidity is crucial, especially when using debt financing. Companies must ensure they have enough cash or easily accessible assets to cover loan payments, lease obligations, and other expenses. Good liquidity management reduces financial stress and supports smooth operations. Before committing to any funding method, companies must evaluate the risks associated with their investments. This includes assessing market conditions, project feasibility, and potential returns. A thorough risk assessment helps companies avoid costly mistakes and choose the most suitable financing options for their needs. Diversifying funding sources helps companies reduce risk and increase financial stability. By combining equity, debt, leasing, and public funding, companies can avoid over-reliance on any single source. Diversification also provides flexibility to adapt to changing market conditions and seize new opportunities as they arise. Negotiating favorable terms is a key part of securing external funding. This includes interest rates, repayment schedules, covenants, and other conditions. Strong negotiation skills can save companies money and provide greater flexibility. It's important to compare offers from multiple sources and choose the best fit for the company's needs. Every funding method comes with legal requirements and obligations. Companies must ensure they comply with all relevant laws and regulations, including securities laws, tax codes, and contract terms. Legal compliance protects the company from penalties and builds trust with investors and lenders. After securing funding, companies must monitor their financial performance to ensure they meet their obligations and achieve their goals. Regular financial reporting, performance analysis, and adjustments are essential for long-term success. This proactive approach helps companies stay on track and respond quickly to challenges. The financial landscape is constantly evolving. Companies must stay informed about market trends, regulatory changes, and new financing options. Being adaptable allows companies to seize opportunities, avoid risks, and maintain a competitive edge in a dynamic environment. Strong relationships with investors and lenders are vital for long-term success. Open communication, transparency, and reliability build trust and make it easier to secure future funding. Companies should prioritize investor relations as part of their overall financial strategy. Sustainable financing means choosing funding sources and strategies that support long-term growth without creating excessive risk. This includes balancing short-term needs with long-term goals, managing debt responsibly, and considering the environmental and social impact of financial decisions. The world of corporate finance is constantly evolving, with new trends like crowdfunding, green bonds, and fintech solutions changing the way companies raise capital. Staying up to date with these innovations can give companies a competitive advantage and open up new funding opportunities. Let's recap what we've covered. We explored the main types of shares, the costs of retained earnings in issuing shares, and the various forms of external financing like bonds, loans, and leasing. We also discussed the pros and cons of each method, the importance of financial planning, and the role of public funding. By understanding these concepts, companies can make informed decisions and build a strong financial foundation. Thank you for joining us on this journey through the world of capital funding. Whether you're managing a business or planning your own investments, understanding these financing methods is essential. Keep learning, stay informed, and apply these insights to achieve your financial goals. We wish you success in all your future endeavors.